Hit it.
It's Friday, December 2nd, 2022, episode 201. I'm Patrick Ceresna.
And I'm Kevin Muir. This week, we welcome Steve Hou from Bloomberg. Steve recently did a presentation at the Bloomberg Portfolio Conference where he spoke about investing in a new inflationary regime. And it's our great pleasure to talk about his research. Then it's time for Talking Charts with our very own Patrick Ceresna, who likes to ask the question, do I always have to be chewing crayons?
And then we end with the segments of No Stupid Questions and Skin in the Game. And well, folks, we might even drink some beers along the way. So stick around. We've got a great show. Lena, hop on. Now, what beer are we drinking this week?
So this week, we are drinking Fluffity Fluff Fluff Cotton Candy Double IPA by Flying Monkeys. Sounds.
You know what? We say we're
terrible.
drinking. Patrick's being a little liberal with his use of pronouns there because he did not manage to get this, and I think it's a little bit of a coincidence.
Yeah, I know. It's so you're on your own in this one, buddy. Go for it. Well, open here and tell us what you got.
Yeah, the little readout about it.
I'm sorry, say that again. Is it my turn?
Yeah, it's your turn.
Is this Cotton Candy Double IPA named as an expletive or a giggle of goodness? Such sweet abominations can be confusing. Brewed with a dose of kitsch, the Flying Monkeys' newest Double IPA brings fall fair flavors to hoppy new heights.
Okay.
That tells me nothing about this beer.
I thought it was going to be disgusting. I really did. I expected it to be disgusting, even though I love the front. It's not bad.
Does it actually
And
taste
it's
like cotton candy?
8.1%.
Well,
It's 8.1%. You are going to be demoed by the end of this session.
the best IPA I've ever had.
Oh.
What?
Yep.
Okay, wait. Well, let's save it for the end. We'll do the rating. Okay.
Yeah. Let me do our
Side
disclaimer.
effects.
Nothing in this podcast should be viewed as investment advice. Listeners should consult an investment professional before making any decisions regarding topics mentioned in the show. Side effects of too much huddle may include FTX fatigue, China reopening runs, and the Twitter takeover toxic shock syndrome.
I've had the China reopening runs. It's awful.
Let's get to the interview with Steve quickly. It's our great pleasure to welcome to the show Steve Hou. And now, when I was asking Steve how to pronounce his name, it's actually spelled H-O-U. And he told me that I could do it like H-O-W-E. And I said that as a Canadian, that's like Gordie Howe. So I'm going to call you like Steve Hou, like Gordie's long lost son. Steve, it's great to have you on the show.
Yeah, thanks, Kevin. Thank you so much.
I've been looking forward to this for a long time. One of the things that we should do before we go any further is you do work for Bloomberg, and Bloomberg wants you to make a kind of a disclaimer. Why don't you go ahead and make your disclaimer before we do anything else?
Yes. So just standard, disclaimer that, what I say here, is that my personal views and, they don't necessarily represent that of Bloomberg's. So.
That's right. Okay. So Bloomberg got lawyers. You're all happy. We're going to have a lot of fun. Steve is actually presented to it was, I guess, a Bloomberg conference, and one of the things was it was really a presentation about inflation and how people might set up their portfolios, and it was one of the greatest things I've seen lately. And I thought I got to get Steve on the show, but before we start to talk about that, I'd like to get to know you a little bit better. Let's just start with the fact that you were born in China, but you actually went to school in Singapore. And why don't you tell us a little bit about that?
Yeah. So thanks, Kevin. So I was born and raised in Wuhan, China. And I left. I went to Wuhan. I guess one of the best, middle schools. It's called the Wuhan Foreign Language School. When I got into the school, some 10,000 students had to take an entrance exam, and I think a few hundred of us, got into the school. So it's not from one of those schools that the government of Singapore back in those days. This was like back in 1999 or 2000, I think, around there. They were recruiting across East Asia. So from mainland China, Hong Kong, many countries like in parts of Indonesia, Malaysia, and so on. And we were the overseas scholars. So, the recruiters will go to the cities and they would, have us take an exam, do an oral interview, and select a few of us to, come to Singapore to attend, the Singaporean middle schools. And I went to the Raffles Institution, which is named after.
Okay, I looked this up because I'd never heard of it. I'm a North American and embarrassingly naive when it comes to these things. But this school was actually founded in 1823, and it's one of the most prestigious schools out there.
Yes, I think it's probably at some point, one of the schools that has the most number of students who go on to attend Ivy Leagues and Oxbridge. So it was founded after. It's named after. It was founded actually by Sir Stamford Raffles. He was a Scottish, I guess, officer based in Java at the time, and he founded Singapore, and he founded the school as well. That's the Raffles Institution.
So you go from China to Singapore, where I recently read that according to Forbes, I think it was, 1 out of every 34 Singaporeans is a millionaire. So obviously the home of the author Kevin Kwan's book, Crazy Rich Asians, and you getting put in one of these elite schools. What was that like?
Yeah, it's quite fascinating. I mean, Singapore obviously changed a lot since I left. I left to come to the US for college in 2000 and end of 2005, basically, because the school calendar there is on the Gregorian calendar. It starts from January, ends in November. So I was there between 2000 and 2005, and Singapore, the economy took off, and then they allowed legalized gambling, and the economy really, I think, took off in a big way after I left. But when I was there, it was really a fascinating experience. Having come in, not speaking really much English, had to sort of adapt and learn English to then take classes, not just in English, but in biology, mathematics, literature, everything in English. That was a massive transition. We had to learn English quite quickly and adapt to living in on this tropical island. That was a former British colony, and yeah, it was a lot really, and the food, the climate, and yeah, just.
Now, did you see, were some of your classmates just obscenely wealthy? I saw the principal of this school, of this raffle school, recently said that he was having trouble struggling to recruit students from diverse backgrounds because some were worried about not fitting in with their wealthier classmates.
Interestingly enough, when I was there, I certainly didn't get a very strong sense that the students were somehow coming from extremely well-off, family backgrounds. But in hindsight, I think when I think back, they probably were. But all of us, we were in sort of, almost like it was a very much of a proper British boarding school. We had even different houses. Everybody wore school uniforms, so you couldn't tell whether students.
Okay.
And I was a school prefect, and they were different. We had different houses like Morrison, Hallett, Moore, named after former school principals that were British, colonists there. So it very much felt like very much of a Harry Potter, kind of a setup. That when I later on, when I started watching the Harry Potter movies, a lot of the same customs mapped to what I experienced. The hat boy, the prefect system, the houses, the rugby, all of that. It felt very much like a familiar. Mm-hmm.
All right. Okay. So you mentioned that a lot of the students from there go on to Ivy League schools. What was your next step after graduating from there?
So I, did my SAT, and I wanted to leave the Singaporean education system. I always wanted to come out to the West, and at the time some students will go on to the UK, and the best students will try to go on to Oxbridge, and I applied to US colleges, and I applied to a few schools, and I ended up going to a University of Virginia in Charlottesville.
All right. What did you study there?
I studied mathematics and economics, double major.
And at that point, did you know what you wanted to do, or what drove you to choose that field of study?
I had no idea what I wanted to do, and this is one of the things. Like I grew up in China, and the society wasn't very, diversified. Like back then, the economy was growing so quickly, but there was not so a whole lot happening, right? And you had just no idea, what society, what life had to offer. I certainly had no idea what American society had to offer. So I studied mathematics and economics because you felt, at least we were given the idea that technical subjects were more assured of some sort of a career, and economics will give you a sense of how an economy works. That probably sounds like money, so you'd be somehow. But I didn't learn any economics, and as an undergrad, and even after I have gotten a PhD, I understood why, having taught undergrads, why I didn't learn any economics as an undergrad at Virginia. But
Okay, well, why don't you tell us what would that insight, like why do undergrad economics students not learn properly?
I don't want to take us too far afield, but like I was a PhD student at Michigan studying financial economics, like some years later, and I taught as a graduate student at Michigan, and I taught basically all the different courses you can possibly teach as if you become an economics major. What I found was that the economics curriculum is just fundamentally very poorly designed, and it wasn't very well thought of. And through the years, you have had basically this set of canon that have been designed and have been put in there probably decades and decades ago, right? Some of it's just probably from all the way from Alfred Marshall probably started. Some of that basic ideas from Econ 101, and there's not a strong incentive for professors who are most of these research universities, top universities, who are so stressed out about getting tenure to actually put in a ton of effort to reinvent the curriculum to make it, I think, really useful to the students. So you get a lot of dogma in a lot of these curriculum that is you're teaching sort of formalism, right? You're teaching all these curves moving around, but you're not really, I think, making an effort to connect it with I think stuff in the real economy. I think part of it is also because a lot of academics haven't really, I think, had themselves the experience in the real economy. I'm sort of simplifying a little bit, but I think if you speak with most academics, they will broadly agree, and there certainly seems to be an effort to try to reinvent the field to make it more genuinely related to the real
Right.
economy.
Well, one of the things I would say as an economics student and that went on to be a trader, for the longest time, I felt it was like useless. I
Mhm.
looked at it and I was like, these models that they come up with, first of all, they just don't work. And I look at like the DSGE models that are famous, especially in the early 2000s. And I thought to myself, these guys, like that old line that Gordon Gekko said, that he said something to the effect, if this guy owned a funeral parlor, nobody would die. That's how I felt in terms of how useful their predictions were. They just didn't seem to work. And Stiglitz is famously kind of crapped all over them and said that we've tried to make it too mathematical almost. Would you agree that we that economics have wandered to trying to be too precise?
Yeah, I think there is something to that, right? I mean, what is a model? A model basically is a map, right? That's the best analogy I've found over the years, right? The map is not supposed to be an exact replica of reality, right? You abstract away from reality so you can navigate from point A to point B. Um, so everybody can have their own model. A trader can have a trader's model. A trader's model doesn't have to be even correct, right? A trader can have muscle memory. You can have a very fantastic trading model that makes you a lot of money that is based on an entirely false, view of the world.
Steve, many of the best traders seem to have those.
Yes, because you pick up muscle memory from markets, right? Every day. Like I used to, like last in 2020 when I was between jobs, between AQR and Bloomberg, I was sitting in front of my computer, literally just watching the market. There is a certain rhythm to the market. You can pick it up by 10 a.m. There's some market tends to like go up and then come back down, and then by 2 p.m., like you can see that there is a pattern to the market that may have nothing to do with a rational model, and you couldn't like. If you're an academic, your purpose is a bit different than if you're a trader. A trader can build a model that works for him that cannot be, easily communicated or may not even be correct. Whereas an academic seeks to find a model that actually is correct, but also has an internal coherence, internal consistency. And that internal consistency is really, I think, what is really difficult. And the reason a lot of these models we have learned in economics curriculum over the years that have become so useless is because there is this overarching constraint, philosophical constraint, that they want to make a model that is internally consistent. And the reality is not that easy. And all of our models are actually not too mathematical. In fact, they are not sufficiently mathematical. They're too simplistic, right? You are making all these assumptions about people being the same because you cannot solve it if everybody's different, right? You have to have numerical solutions. So what you have all these simplistic assumptions. So you have to, in order to you come to a solution, and that's how they come to this whole idea of equilibrium, right? You have to make certain assumptions, simplifying assumptions, so that the model is solvable, and early days, solvable by hand. And I think that's what's led to a lot of these, seemingly contradictions, if not absurdities, at odds with reality. But over time, I think things are evolving, especially with empirics. People are. I mean, in the old days, we didn't have as much data, right? And nowadays there's so much data, not just in the time series, but in the cross section, that people are checking all these models that were wrote down in the 70s and 80s, the golden age of pure speculation, right? All these models gone wild, and now we're checking the models and realize, these models actually this one is false, this is actually maybe true, and so on. So I think that's part of it.
Well, that's interesting. So, okay, let's just follow your career, and eventually we'll get to how those models might be used in the real world. You go to school in the States. First of all, what was that like coming from Asia to to Virginia?
Oh, gosh, that was actually a massive cultural shock, as you can
I
potentially
can
imagine,
imagine.
because most of my friends, typically when they go to school, the very best schools, they typically go to the Northeast, right? Boston area and New York or whatever. I happen to have chosen a school in the American South, not realizing at the time that there is such a thing as American South. So I showed up in Virginia, in Charlottesville. I think the first day I was trying to cross the street, and this lady, stopped some 50 feet away from me and letting me cross, and I wasn't sure what was going on, because I was much more used to living in a big city where everyone honks at you, right, coming up right up to you and hurrying you, So that's how I got acquainted, as my first introduction to the U.S. in the American South, and and then I was there.
The slower pace.
Slower pace, and people are really nice to you, and there's a certain you are from North America, you've been around Americans, and there is this difference between your Yankees and your American sort of
Right.
South America.
Okay, so you get your undergrad there, and then do you immediately go to grad school, and you go back overseas? You go to Europe, if I'm
Yes,
not
yes.
mistaken.
So I've been actually a lifelong student until I started working, and after UVA, you remember this was like I graduated in 2010, and right after the financial crisis, and the job market wasn't very good. And I actually didn't really even have a very strong sense that there was actually a financial crisis, because I had come from China, and China didn't really suffer from financial crisis the same way, because the government, sort of stimulated the economy. So my parents, didn't really give me that sense, and I just knew that I could sense the American job market wasn't very good. So, but in any event, I wanted to keep on studying, and I wasn't sure. I really, I hadn't learned any economics. I didn't really enjoy that much. I enjoyed mathematics very immensely. So I applied to a bunch of mathematical programs, and one of them I got accepted to was the Swiss Federal Institute of Technology, ETH Zurich. And I went to Zurich to study mathematics, a master's program.
Right. And so while you're there, you teach yourself German?
Well, I already knew German by that point, because I had.
Oh, you
Yeah,
did?
I had lived when I was living in Singapore. I actually dated a girl who was who's Austrian, and I started learning German, and then along the way I kept learning it. So by that point, I already knew German. But funny enough, when I showed up in Zurich, thinking that I might actually finally get to use my German, I didn't get to use it, because Swiss German is entirely a different language from German. High German, and the Germans actually couldn't understand the Swiss German. The Swiss German intentionally speaking Swiss German in front of the Germans, so that the Germans couldn't understand. So that because they were the locals.
Oh, I didn't realize that there was a difference.
Yes.
You know what you needed to do? You needed to find yourself a Swiss German girl, and then you would have learned the language again.
Yeah. So High German say something like cheesecake will be Käsekuchenli, right? And then Swiss German will be
Yeah.
Käsehueli, and they are supposed to be the same words, but they are not sounding the same at all.
Wow.
Yeah.
Okay, so you go there and you're studying. This is a slightly different tack, right? It's no longer economics. You're doing
Yes.
financial.
Yeah,
Why don't you tell us
I
about
was
the
studying
degree?
financial mathematics, and I think this kind of tracked a little bit the trajectory of what is popular on Wall Street at the time, because I still wanted to stay close to finance. I wanted to, I studied undergrad economics. It didn't feel very technical, so I wanted to study something like finance. And at the time, I think that was towards the tail end of sort of derivative pricing. You have all your sort of PDE solvers, physicists coming in onto Wall Street pricing Black-Scholes and all sorts of fancy financial derivatives, exotic jump processes and whatever. So you could study something called stochastic processes, right? And try to learn how to price these derivatives. So that's actually part of the course that I took when I was in Zurich. So I studied, financial mathematics. Took classes in stochastic processes and sort of.
So you became a quant, and then
Yeah.
just to make sure to cement your kind of your cred as a quant, you go to Ann Arbor, University of Michigan, because you figure that you need to learn some football as well while you're there, and you get a PhD in this. Is that correct?
Yes. So after spending a year in change in Zurich, I returned to Ann Arbor to do a PhD in financial economics. Yeah.
So then from there, you get hired to AQR. So one of the things that you talked about was when she went there. Well, first of all, before we talk about this my question, let's ask, what was it like moving from academia, which you had been in for a long time, to the kind of the real world or the business world?
Yeah, it was actually, kind of it was a bit of a struggle, actually, to be perfectly frank. I joined AQR in 2018, and in August, that was after spending, nearly 7 years in Ann Arbor, as a PhD student, where I had always meant to become an academic, or even perhaps join a central bank doing some sort of policy oriented research. Instead, I decided that I wanted to try my hands at the private sector, and I joined AQR in 2018, and I found myself sort of not, I think, being able to so readily translate what I had learned in grad school in the private sector setting. And the coding was also a bit different. The empirical work was a bit different. So yeah, you took a bit of getting used to.
Coding in what way? Meaning the way that people spoke, or coding as in actual coding where the languages that they use to program these things?
Yeah, so language, literally, when I was in grad school, I mostly coded in MATLAB and maybe another statistical language called Stata, which is very much oriented to economics. And when I joined
Right.
AQR, everyone was using Python, and in fact, Pandas was invented at AQR, right, by McKinney. So I didn't know Python very well, and I had to learn it, when I was there, and also sort of adapting some of the stuff that I had gotten used to doing in grad school in a private sector setting.
Now, how is your Python programming now?
Oh, I've by now I've certainly honed it. That's one of the things that PhD teaches is a skill set to learn new skills, right?
Right. Okay.
Yeah.
Okay. Now, one of the things that when you went to AQR, you were in the midst of what you called the factor winter.
Mm-hmm.
Why don't you tell us what a factor winter is? Like, it made me think of Game of Thrones. I felt like when you referenced that, I thought you were on the North Wall.
Yeah, so I think so for people who are not familiar, well, I mean, I'm sure most people have heard that AQR is basically the holy grail of factor investing, and many of the factors, in fact, were invented there, and these are factors that have been backtested over a long period of time, decades, across geographical areas, that have been shown to demonstrate positive risk premium, and when you combine them, then you sort of take advantage of the correlation. This is supposed to be a system that is supposed to work well, but it turns out that after especially after the GFC, a few years after GFC, like the value factor started not, performing very well. In fact, it started having a pretty severe drawdown, by the time, I joined AQR in 2018, and then carried on drawing down, I think, all the way until basically well into 2020. But the thing that was nice at the time is that, when value is not working, there'll be other factors such as momentum, like investor sentiment and other factors that will actually carry on working, so that overall you're still doing all right. But by the time of 2018, I think a lot of the factors, stopped, working very well, and they're all sort of drawing down, in various ways, such as the overall performance, of the funds was, were not great. And I sort of witnessed, sort of firsthand, the, so to speak, factor winter, which I think a lot of factor funds experienced. It wasn't unique to AQR, but
That's right. Sitting on the north wall in the cold is not fun. Okay, so you end up at Bloomberg, and we're going to talk about a presentation you've done recently. And for those who want to follow along, we're going to include this in the show notes, and you can actually see Steve's slides. And you recently made this presentation, but we're going to go through it in a little bit more detail, because when I saw the presentation, you were tight on time, and I had a bunch of questions along the way. So we're going to have a little bit of Kevin and Steve Q&A as we go. Anyways, it's called Investing Through a Structurally Inflationary Regime. And I think it's just a topic that's so near and dear to my heart, because I've been arguing for a while that 1982 was the start of kind of a reliance on monetary policy at the expense of other fiscal policies, and that we went through this disinflationary period for the last 40 years. And that this has changed. And a lot of what you're talking about has similar themes, similar rings to it. It sounds very familiar, but you articulate it in a much better way. And more importantly, you include the stats to back up a lot of the things you're saying. So why don't we start with something that is, I kind of laughed when I saw it. You said the 4Ds of inflationary undercurrents. And I used to talk about the 4Ds of deflation or disinflation, and you managed to come up with the 4Ds of the other way around. Why don't we start there, and you can kind of walk us through your themes?
yeah. So, I was actually,
Sorry, 1 second. I didn't mean to interrupt you there. Will be page 2 for those who are following along on the slides.
Yeah, so this is basically the start of my presentation, and I'm trying to describe a macro backdrop of my presentation and what motivated me to think about this topic, actually in 2021, like, sort of a beginning of last year. And I was very confused about the rhetoric of inflation is transitory. And I was seeing all this debate on Twitter, and I kept thinking that really transitory didn't really mean a length of time, like, being a short time or a long time. To me, underneath it all, if there are structural forces, right, that would anchor the U.S. or global economy in a very disinflationary type of a way, things such as technology, globalization, automation, and all these sort of secular deflationary forces that we believe to be very powerfully deflationary, then there's really nothing to worry about. Like, who cares if we get, some high inflation print for a year or 2 or even 3 years? Eventually, we're going to revert back to that deflationary world. But as the more I thought about it, the more I thought maybe the opposite of transitory really is not about the length of time, but about structural, right? And it's about asking the question whether or not they are structural forces, right? Inflationary structural forces that have been undercurrents that were building over the previous decade, that are actually independent, right, of the pandemic or the truly unprecedented policy responses. And I thought perhaps the reason why everyone thought inflation was transitory is because you've got the pandemic and the policy responses that are themselves transitory, that are actually a bit of a red herring, but maybe but the trigger for these inflation undercurrents, which I summarize as these 4Ds, right?
Okay.
So, the first D being decarbonization, the second D being demographic aging, the third one being deglobalization, and the fourth one being dominance of fiscal policy over monetary policy. And we can walk through each one of them.
Sure, let's do that, because they're fascinating, and I realize that we're probably going to make your presentation a lot longer, but let's go through them, because I think that they're important to think about when we're setting the stage for what we're seeing.
Yeah, I agree. So yeah, so decarbonization is the first D, right? And I'm thinking about here is like, we've been basically one of the biggest themes, right, in the global economy is that we're trying to decarbonize our, entire global economy. But it turns out, paradoxically, it takes actually a lot of carbon to actually decarbonize the economy, right? You actually need a lot of metals, right? Copper for electrification, for the adoption of EV means that we need copper, we need lithium, and all these different, making batteries. And along the way, we also need, sort of energy to power the construction of a lot of the infrastructure that will help us decarbonize, which means that we're going to need more crude oil, we're going to need more, coal, and some of these sort of dirty, commodities. At the same time, there seems to be, I think, a general aversion, or I think a shift away from investments into these commodities, because these are dirty industries. So you have this paradox that during the transition we have an increased need, and also a unwillingness to invest. So that is the first D that I think could be, again, sort of in this transition period, the next say 7 years, right, 5 to 7 years, that could be inflationary. That's the first D. The second D,
Right. And I think one second before you go on, I think that that's an important part that you mentioned, that people don't realize that we actually are going to need more energy to get to a green economy. And it's one of the things that just kind of frustrates me is that we are sitting back trying to actually discourage investment in fossil fuels because we think we have to go green, but unfortunately to get to green, we're actually going to need more fossil fuels.
yeah, indeed, there is that paradox, right? If we are gonna, we right now oil prices are been going up, and we've been telling people that we need more oil refineries, we need more oil production. But who is going to want to invest in an oil production facility that can only be recuperated over the next decade or more? When you're telling them that in 5 years you'll be irrelevant,
That, and not only that, you're also telling them that you're going to tax them if they make any more
Yes,
at a higher
yeah.
rate. It's just it just it doesn't seem well thought out, but I think that we have to spread that message that you need more energy to get to the green economy, and I think that that's something that's overlooked. And I'm glad you're bringing it out. Okay, what's the next D?
So the next D is demographic aging, and of the working population in particular. I'm thinking about sort of there is I think a geographical and a timing mismatch here. We've been relying on over the last few decades on an endless abundance of cheap labor in East Asia, in China specifically. But China, as we know, is aging very quickly. Its working population peaked sometime in 2014 or 15, and is facing a aging cliff really, and the younger people are not willing to, I think, work in some of these sort of harsh conditions. We've seen recently the protests in the iPhone factory in Zhengzhou, China, and that's just one of many where sort of people, you have this army of 300,000 young people who are living in the dormitory day in day out making iPhones, and I think it's not a particularly pleasant lifestyle, and many of them are increasingly saying no to it. So you have, on the one hand, a shrinkage of sort of supply of cheap sort of working age labor in East Asia. On the other hand, in America, I think even the American demographic have been aging, prior to COVID, and most recently, I think Powell just said at his press conference at Brookings that not at Brookings, but we had a lot more people retire, right, than we had previously
Right.
anticipated, and there was also always this assumption, intuition that old people don't consume as much. They're going to cut down consumption, don't buy housing. But the thing is, you've got all these people who are just retiring. They're not going to really meaningfully cut down their consumption. They're going to start traveling, in fact, and draw down some of that wealth that accumulated over the past couple of decades. So I think you have that, again, the next few years where you can potentially have, on the one hand, right, shrinkage of cheap labor. On the other hand, still a pretty robust, consumption from an shrunken workforce.
Yeah, I completely agree, Steve. One of the things that I like to say is that we had a huge labor kind of supply event that occurred with the fall of the Iron Curtain, with the Berlin Wall going down, and also with China entering the WTO. Both of those things sent so many workers into the global kind of economy. And now we're seeing that there's just everyone's thought that there's always going to be cheap labor, and it's not there like we might expect. All right, which brings us to the third D, deglobalization. What's the theme behind that?
Right. Yeah. So this actually is related to what we were just talking about, right? So we saw over the past 40 years, one of the biggest trends was actually a globalization of trade and movement of goods and people, and that actually was anchoring, right, the inflation that disinflation that happened since the end of the 80s. People often sort of like to credit Paul Volcker as being the person who killed inflation in the 80s. Broke the back of inflation. But what I think is that while it's true that Volcker, through so hiking interest rates to really high levels and inducing all this recession, killed demand, what really brought down the volatility of inflation was actually a sequence, right, of very favorable large supply shocks. Right, we had NAFTA, we had China entering the WTO. In 2000, that was really big, and the globalization really was, I think, what fundamentally led to that 3 decades of very low and stable inflation. Now we're seeing a reversal of that. Obviously, Russia, invasion of Ukraine, which has now led to basically a cessation of energy trade in Europe, and now there is basically we've been seeing increasing frictions, right, between the U.S. and China. Which is the global factory, and China itself has actually sort of looking through ways to reorganize its economy and shifting away from some of the lower end, manufacturing anyway. So we're seeing trends of reorganization of supply chain reshoring, right, friendshoring, so to speak, right, movement, right. Moving some of the manufacturing of iPhones to India, moving some manufacturing towards Southeast Asia, and so on. And this process, right, is not going to be smooth sailing, right, because you're moving from a country that had sort of honed vertical supply chain to a T in China, right, to places like Vietnam or India, where lead time can easily add another 3 to 6 months with like a lower, perhaps QC yield, right? So, that's going to be, I think, a potentially bumpy road, ahead.
Right. So if globalization was part of the disinflationary trend of the past 30 years, then deglobalization should see that be the opposite, which is inflationary, which brings us to the final D. And it's one that's near and dear to my heart. Why don't you tell us what it is?
Yeah, so this one is actually called the dominance of fiscal policy, of monetary policy, and is perhaps, I think, the least familiar to people and sounds as vaguely obscure. But this really hails from the famous paper by Sargent and Wallace and Neil Wallace. When they were talking about basically there is this competition, right, between the fiscal authority, which is the treasury, the government, and versus the monetary authority, the central bank. And at any given time, what emerges in the sort of monetary economics is which authority dominates the other. And dominance of fiscal policy over monetary policy just means that when there is such a huge stock of debt, right, government debt, that needs to be rolled over, right, onto, say, an unaffordable level of interest rate, then the central bank obviously is not going to let the fiscal authority default, not going to let the sovereigns default. So you basically is forced into a situation where we either have to cut back on spending, or you basically start monetizing the debt, right? With the central bank backstopping government spending, and dominance of fiscal policy of monetary policy just means that sort of you are in the second scenario where governments actually do not severely cut back fiscal spending. Instead, we start to see a monetization of debt.
Now, when you mentioned this on your presentation that I saw watched on Bloomberg, you talked about this famous macroeconomic paper, and I was embarrassed. And I now that you say that the undergrad economics programs don't teach you very much, I feel better about it. But I wasn't familiar with the paper, so I went and Googled it and tried to figure it out. Is it this 1975 paper? Is that correct?
You're talking about the Wallace Sargent paper, right?
Yes. Yeah, Sergeant's Wallace is it's Sergeant, like it's not like Sergeant as in like one up or down from lieutenant. It's Sergeant's, right?
Yeah.
Wallace.
So Tom Sargent, he was a Nobel laureate with Chris Sims, and he's one of the sort of all-time greats for structural macroeconomics. So he wrote this, I think it was unpublished in working paper when he was at the Minnesota Fed, and they basically did some sort of simple modeling to make this point, right? That you can have these two regimes.
Right. And so we get to this point where the central bank is forced to do yield curve control, or what was the second part of it again? Because I'm curious about this paper and what it says, and how that we can think about that in terms of today's environment. Because does it not sound a lot like what Carmen Rogoff wrote in terms of this time is different?
Yeah. So indeed, I mean, they basically in the paper spell out these two types of regimes, right? Where if monetary authority dominates fiscal authority, then you have a stable monetary regime, and the central bank is allowed to be fully independent in setting its policy when it comes to either stimulating growth or controlling inflation, and governments basically have to be borrowing with a certain the fiscal discipline, right? More or less constrained by their budgets over time, right? But when you get to a point where, if you look at the next slide in my slide deck,
okay, let's go to slide number 3.
We are looking at the debt to GDP ratio that was last seen during World War II, right? This was the bottom right chart, right? And this is amount of government debt held by the private sector. You can see this big swoop, right? It was really, really high during World War II when we, forced everyone to sort of, conserve consumption, buy war bonds, and turn the economy into a military production, constrained civilian production, right? That was when we had a ton of debt. And since then, debt to GDP ratio have been steadily decreasing because we had real economic growth and debt was not, very high. Deficit was not very high. But since, around the 70s, we've been on the upward march, right, towards until the present day, where we basically are sitting at, a historic high again. And when you have so much debt, it becomes, arithmetics changes because, as interest rates, rise, and we have to roll over the debt in the next few years onto higher interest rates. If government spending does not, decrease, in tandem, you maintain the same level of deficits, you start to see this math not adding up, right? It's not like the US cannot pay its debts because it can always print money, obviously, but
Right.
you will have faced this issue where tax receipt, right, which is a certain share of GDP, has to be equal to the sum of government spending, most of which is non-discretionary, plus
Right.
debt service, right? And if the sum of the latter half is greater than your tax receipt, you either have to basically raise taxes, potentially during a slow economy, or cut back spending, or you monetize the debt and to pay for interest.
So the argument being that as we get into an environment where there's a higher debt to GDP ratio, we're going to likely experience higher inflation and also and am I correct, volatility of inflation?
Yeah, at that point, I think that becomes quite speculative what is actually going to be happening to the inflation dynamics. I mean, everyone always looks to Japan, right, as the example of, Japan has, some, I don't know, 200% debt to GDP or whatever, and they seem to be suffering from, a case of deflation and inflation.
Right.
But I think it's quite unclear what happens if the whole world tries to be Japan, right? I think Japan partially, my speculation here, my hypothesis was that Japan was able to be Japan because the rest of the world was not Japan, and they were able to outsource a lot of their production overseas, while domestic, labor became ever more expensive, and they benefited from, the disinflation of Chinese, exports and so on. But when you are in a world awash with debt, right, that becomes, I think, trickier. And what is, I think, particularly interesting, and what I mentioned on this page also, is that in my PhD research, right, I actually studied this exact question. I looked at what happens to basically bond yields, specifically through term premium, when treasury supply increases. And what I found is that historically, if you look, since end of World War II, is that bond yields actually responds more, right, to treasury supply, being forced to be held by the private sector, when the stock bond correlation is more positive.
Okay, so let's go. We're gonna kind of take this one step at a time. Let's first start with bond term premium. Why don't you explain to folks what that is?
So, bond term premium or risk premium, puts very simply, is basically the excess, return that bond investors demand. Right? So, if you buy a long-term bond, right, long-term interest rate is supposed to be right, the average. Cumulative, of short-term interest rates, if you roll over short-term bonds. But typically there is an excess return, and that excess return is typically explained by the fact that I demand, additional compensation for holding on to a longer maturity instrument, right? That is
right now. The thing that kind of trips a lot of people up is, how does that differ from the yield curve? Because you might just say, look, we have a 2 years trading 4, a 30 years trading 5. Therefore, they're demanding an extra 100 basis points to hold it for the extra 28 years. That's not the same as a term premium?
Well, so there is the yield curve is when it's typically positively sloped, right? When it's upward sloping, that is actually reflecting partly that is reflecting sort of the term premium. Term premium is kind of a amorphous concept, like people can define it in different ways, and it has to reflect expectations of short-term interest rates, how you're going to evolve into the future, and the excess over which you call a term premium. So when you go out there, there's actually not just one term premium, but many different ones. The New York Fed, for example, famously has a term premium that's estimated using a particular type of term structure model. But then you have other people that sort of look at their own macroeconomic models and come up with an expectation. But I think the crux of the issue here is basically how you actually form the correct expectation, right, that reflect investors' expectation about short-term interest rates, above which that is the term premium.
Right. So another way to think about it is that if you asked an investor what they expected rates to be each year for the next 30 years, and then said, okay, but what would you require me to, how much extra yield would you require to commit to those 30 years? That would be the term premium. Is
correct.
That correct?
To compensate for the volatility in interest rates, for example, right?
Right.
Because investors are risk averse.
Now, okay. Now, so we understand the term premium is kind of the yield curve, but a little bit more. So it's how much people are demanding to go out the curve in terms of versus their expectations of what they expect. Let's just say the front end policy rate to be over the period of that they're investing. Now, you mentioned that at times of QE, or why don't you tell us, what your PhD was about?
Right. Yeah. So there, as I mentioned, there are different ways you can measure, term premium, and whatever it is, there's a general sense that long-term bonds earn some excess return. This is the sort of the risk-based compensation for these long-term bonds. And I was trying to find essentially, what is this excess compensation that investors demand, as a function of treasury supply, right? Does the treasury supply actually increase it? In theory, the intuition says that you should expect, right? If someone is trying to sell you more of something, you expect sort of a price concession, right? In this case, the price of risk needs to reflect, the supply. And what I found, it turns out, this was motivated back in 2018 when we were trying to understand the Fed unwinding its balance sheet, right? Which is effectively, right, for offloading this treasury bonds that the Fed was holding onto private hands, right? So effectively, it's equivalent to treasury supply. We were trying to understand like what this was going to do to long-term interest rates. And what I found was that long-term interest rates responded more, right, to treasury supply when stock-bond correlation is more positive. I think it's kind of sounds like a mouthful because I'm talking about bonds, I'm talking about bond supply, I'm also talking about stock-bond correlation. But if you bear with me for just a second, right, it turns out, right, basically what I'm saying is that, the price people demand for bearing the risk of holding these additional bonds, right, that is being issued to the market depends on basically the risk properties of bonds, right? That's quite intuitive, right? If bonds add to my overall riskiness of my portfolio, I'm going to demand a bit more, right, in terms of returns.
Right.
And if bonds actually, are negatively correlated with the rest of my assets, which would decrease the overall volatility of my portfolio, then I'm perhaps going to demand a bit less. If anything, I might actually pay for it. Yeah. So that's exactly what is being proxied here by the stock bond correlation. When stock and bonds move in the same direction, right? When I offload bonds onto you, when I ask you to hold more bonds, you're going to ask me to pay you more, right? Because bonds are going to add to the overall volatility of your portfolio. Now, when stock and bonds are negatively correlated, then in that case, you're not going to ask me for as much of a risk-based compensation. And
right. And, sorry, I didn't mean to interrupt. And there's the famous hedge fund, Bridgewater, that did, took risk parity and took that relationship, and it made the kind of the richest hedge fund manager out there with Ray Dalio by exploiting that tendency.
Indeed, that is the case. So if you look at the top right chart on this deck, on page 3, and you look at the evolution of stock bond correlation, how it has evolved over the last, many decades since World War II, let's say. It's actually been very interesting. There has been a regime shift. You can clearly see there are two regimes here. That there is a black dotted line around the year 2000, before which stock bond correlation has tended to be above the zero line, which means that stock and bonds were positively correlated. And then after the year 2000, stock bond correlation turned negative and actually, became ever more negative, until the financial crisis. And from then, it sort of started, going back, edging back up.
And why do you think that is?
So there is actually a very famous paper, one of my favorite, really, by the economist John Campbell, who is the founder of Arrow Street Capital at Harvard, and his co-authors Sundaram and Adi Sundaram and Louis Viscera. So they make the argument that stock bond correlation basically is reflecting the fact that inflation have at different times been muted versus dominant, right? So when inflation is a very dominant force in the economy, everyone is worried about inflation to some extent. This was the case basically coming out certainly during the 70s and 80s, even a few more years afterwards, because memory was still fresh, that inflation enters the discount rate, right? So that is going to mean that stock and bonds move up and down at the same time, right? Because, if you think about a simple DCF, formula for pricing an asset, you are discounting cash flow back to the present. When inflation rises, that's going to move, stock and bonds both down, and when inflation goes down, it's going to move stock and bonds both up. Now, in a disinflationary environment, which is the case, since around 2000 onward, the last 2 decades, inflation has been very muted. So much so that we sort of stopped worrying about it. It became sort of an afterthought. In this environment, cash flow dominates, which benefits stocks. Positive cash flow shocks benefit stocks. And this was especially the case, around 2008, when global demand, became very deficient and you had no inflation. And this is an environment that's perfect for a negative stock bond correlation and perfect for a strategy that tries to exploit, right, this negative correlation.
Right.
Does it make sense?
Okay. Now, yeah, I'm with you. Now, you think that this is changed though, and that this stock bond correlation is a harbinger of things to come. Am I correct?
Yeah. So if you look at what is right now, I mean, if there's a red circle that I'm putting on the chart right there, stock bond correlation has been surging positive, in the last, few months since basically this year. And we don't know. I mean, this is one of those things where it's a regime shift, just the same way when it happened in 2000, then when it plunged to be very negative, we didn't get any sort of clear warnings beforehand. There is a chance that this might just sort of be doing a reverse of what we saw in the year 2000, and to the extent that we think the last 10 years were perhaps not sustainable, we're not going to go back to it. That this is potentially signaling that there is an economic regime shift, coming.
Right. Okay. So we can summarize it. We have the 4Ds of kind of the new inflationary regime. We have the stock bond correlation going positive, and we have this high debt to GDP ratios. All these things are kind of at the very least signaling that inflation might be more of a problem going forward, and that this might not be the transitory inflation that people were talking about, let's say, a year ago. Now, this is where we get into the good stuff. You get on to page 5, slide 5. You talk about the different ways that this should affect, or at least different things that investors should think about in terms of if this is a new environment. And why don't we start with this first one, where you say equities are generally not a great hedge of inflation?
Yeah, so I begin my presentation doing a survey of all assets, how they behave across inflationary regimes, and I begin with equities. And equities are, it's interesting because sometimes people have, at various points said equities may be viewed as a real asset, right? Because it is, after all, a claim onto a real business that generates profits, right? So if it's a real asset, you think that, if there's inflation, then my nominal revenue will go up with inflation, that you shouldn't be that affected by inflation. But in reality, if we look at what has happened in the data, and here I, sort of plot this plots, that I for all of the assets, where I basically look at historical realized, inflation, and I show basically how an asset has performed, right, in each of these sort of regimes. I plot things in such a way that I group the observations into percentiles, quintiles, or deciles, since these are rolling year-on-year inflation and rolling year-on-year total returns of the asset. And so if you look at this graph here, instead of having a cloud of dots, I basically have either 10 or 5 these vertical lines. The middle point is the average return, right, for that particular group, right, of realized inflation, and the vertical line shows you basically the confidence interval. So you can see basically as we evolve through, right, these different regimes of inflation, experiences, how the total returns have evolved. And what is interesting here is that if stocks were really a real asset that is not terribly affected by inflation, you would expect a horizontal line, right? Because total return would more or less stay flat, right? As inflation increases, you get higher revenue. But in reality, what we see is that depending on the horizon you're looking at, whether you're looking at, more recently, you see this hump shape, curve, and you look at a longer horizon, you see this distinct downward sloping curve, which suggests that stocks actually tend to do more poorly, right, when inflation rises.
That's right. So for those that are kind of trying to picture it in their mind, it's the real return after inflation of the S&P 500, and on the bottom axis is the CPI, and then it shows the different returns over the period. And to Steve's point, if it was, let's just say, if stocks were actually a great hedge against inflation, it should be just a straight line, and instead it's a down, horizontal line, and instead it's actually a downward sloping line, meaning that when you look at the total data set that he went through, which is 1940 to 2022, as you go and you get more inflation, actually the real returns go down. And then interestingly, when you look at 1988 to 2022, it's got a little bit of it's an upside down. It's like a frown instead of a
hump
smile.
shape.
Yeah. And I guess that's showing you that there is like a sweet spot for the inflation, whether it be 2 or 3
Yes.
or 3.5%, where they do the best. But then after that, you actually get stock returns going back down again.
Correct. Yeah.
All right. So now, so kind of that's, first of all, surprising probably for a lot of people, because there's definitely a large school of thought out there that, oh no, you should own equities. And I guess if you think about it, equities versus bonds, there's no doubt that equities are probably going to be better than bonds.
Yeah, better than nominal bonds. Yeah.
Right. Oh, right. Okay. Now let's go to the next slide here, because you talk about sectors.
Yeah. So it turns out the reason, of course, equities do poorly, right, in an inflationary regime is because cash flows are squeezed because of profit margins being squeezed by higher costs, right? And then inflation also drives up interest rates, which drives up discount rate of cash flow, which are pushing assets down. It turns out if you look at assets, equities, right, across sectors, some sectors are going to benefit more than others, because it turns out, while it's true that all the sectors may face higher costs, there is going to be this effect where consumers concentrate their spending towards the essentials, right? And cut down spending on discretionaries. So if you look at sectors, it is indeed the case. For example, sectors that have done pretty well, right, as inflation increases, are energy, healthcare, utilities, consumer staples, right? This is reflected by the fact that the line does not trend particularly, downward as we move to the right, as inflation increases, right? So the real return maintains, at a sort of flattish level, or if anything increases for energy, right?
Yeah, that's actually fascinating. So for those three, or at the very least, let's just take healthcare and consumer staples. It is the horizontal line that we would have expected if you did believe that equities were a hedge against inflation. And then for energy, it's actually a positively upward sloping, which is the opposite of stocks as a whole.
Yes. So energy does this kind of in an expected way, because after all, energy sector benefits when energy products like crude products, increase in price, and is sort of. But those are actually an entry into your CPI, right? They are actually part of your consumption basket. So the energy sector being upward sloping is unsurprising. That it does very well when inflation is very high, but it crashes, right, when inflation is really low, when you have a recession. So that's why it's negative on the left end.
All right, now let's go to this next slide 7. How does this one differ from 6?
Yeah, so this was actually at the suggestion of someone I've spoken with on Twitter, Mr. Blonde. He was, sort of wondering, how actually, active returns of, different sectors, looks like, sort of how does individual sectors behave compared to the overall market. And you see some of the similar patterns, but some sectors actually are quite revealing. So, for example, energy sector relative to the S&P 500, overall, still shows this, sort of upward sloping line, right? So it does really well in an inflationary environment and does really poorly relative to the market when you have a
Can I just interrupt here, Steve, so that everyone understands? So this is in essence, if you were to buy energy and short S&P in equal amounts. And that the return profile from that. Is that correct? Okay,
correct.
Okay. So energy looks almost the same, almost no different.
Yeah, and then you look at some sectors, the defensive sectors like healthcare and consumer staples, they almost show this sort of smile shape where they tend to actually do better, in both high inflationary environment and a recession, right?
Ah, okay.
And this is, I think, particularly interesting. I think you also see it vaguely a little bit for utilities. And this is kind of interesting because, if you sort of think back about the 70s, that experience, that was the sort of inflationary episode. We had not just one inflation peak, we had 3 peaks of inflation, right? Interlaced by 4 recessions. That when you have an inflationary regime, you can have this sort of rapid regime shifts in and out, right? Coming in, stagflation, recession, and then when you get out of the recession again, because supply is still tight, you have then inflation again. And assets like this can actually be helpful when you are trying to deal with a very highly volatile, regime.
Okay. And the other thing that's interesting is the industrials. It looks almost similar on a relative basis to energy, meaning that it's an upward sloping curve to the right.
Yes, but industrials, are kind of interesting because they are very pro-cyclical, right? So they benefit in an inflationary growth environment, but ultimately when the economy, turns into a recession or stagflation, industrial still suffers from the collapse of overall demand as investors concentrate spending towards the essentials.
Right. All right. Now let's go to the next slide here, which shows energy sectors, which is the slide number 9.
Yes. So this is actually just sort of, so far we've actually been looking at data from 1988 onto the present. And if you really want to look at, a genuine inflationary, regime such as the one we saw in the 70s, you couldn't really just use data from 1988 onwards. Instead, what I did here is that I thought maybe I can get industry returns with a longer history. And I took the Ken French website's definition of industries, and I map them loosely because they are not quite gigs, but they are mapping closely enough that you see that nearly all sectors in the long only context, right, will have a downward sloping line. In other words, when inflation ratchets up really high, no sector sort of can escape unscathed. Even energy starts bending backward, as you can see. The real return starts declining at a very high inflationary level.
Steve, I got to ask you because I don't think people understand how much work that is. A lot of people think, oh, well, he just kind of looked at the different groups and he just figured out, put it into the computer and figured it out. But what you were saying, if I got this right, is that there are no groups going back that far.
Mm-hmm.
And you actually had to go and figure out the groups and make the returns from like 1940 to 19 whatever it was.
So yeah, the returns, these industry portfolio returns actually come from the Ken French, Farmer French, the Ken French, Professor French's website. So they make these industry portfolios returns available.
Oh, so they did. So you went and they've done the hard work of creating the returns for the different subgroups.
I took their returns and I applied the same methodology and created the return profiles for these industries spanning this.
And for the budding quants out there, that's all free, right? The Professor French, I believe, is it French and Fama, or do they both do it, or is it just French?
The Professor Ken French maintains the data. I think I'm not sure who actually did it. I think they probably
right, but it's all free though for everyone, right? Like you don't need to, for those that are interested, go Google it and figure it out. There's lots of free data for you there, and you can do all this stuff at home. Okay, and the conclusion from this is high enough inflation, everyone loses. Is that correct?
Yes. I mean, energy still overall is positive, but you start seeing that real return starts declining. It's no longer a monotone upward sloping line, right? So I think the lesson is that when you get really high inflation, long only assets are going to suffer.
Okay, now let's start talking about. Actually, I mentioned French Fama, but the kind of they're the godfathers of factor investing, are they not?
Yes, they are indeed.
And so now, in their honor, we've gone and you've created the same thing for their different styles in slide number 10.
Yes, since we just saw that long-only investing is going to suffer in very high inflationary regime, I wanted to sort of take a look at what long-short style factors will look like, right? I sampled a few famous ones. So here I've looked at value factor, right? Momentum factor, profitability factor, and the quality factor. So for those of you who are not quants, who are not factor quants, I think loosely speaking, right, value factor is you are sort of systematically picking up companies that is cheap, and you are selling short companies that are expensive. And the definition of cheap and expensive can be defined in different ways, whether it's book to market ratio, whether it's price to earnings or whatever. Generally, they're pretty well aligned. Here, I'm just basically taking the generic definition from our French definition for value or momentum, the profitability and the profitability factor. They all come from the French website. And then the quality factor, which is quality minus junk, right? That comes from AQR's website, which is also freely available. AQR makes a lot of these factor returns freely available.
Okay, and so what's the conclusion you come to here? Just kind of glancing at it, it's that everything stops working as inflation gets high again.
Well, not quite. So what's interesting, what comes out of this is that value and momentum actually tend to do pretty all right in inflationary regimes. You can see on the top left chart, that's the value factor. It actually tends to sort of steadily increase as inflation rises. This is data starting in 1964, so we are already including, right, the most inflationary episodes in the 70s and 80s, and this is, by the way, a long short portfolio, right? Cap weighted,
Yep.
And you only start to, I think, turn back down a bit towards the very higher end. So, that's part of the reason why, for example, over the last 18 months, you look at value factor, value funds, if it's long only, has actually outperformed the market, has drawn down less. And if you look at long short factors, if you're on a terminal, you look at FTW, our value long short factor has actually really outperformed, and a lot of the value, factor funds have outperformed. AQR has done phenomenally well this year, partly because value has just done so well in the inflationary regime, consistent with history, right?
Okay.
That's value. Now, on the other hand, the other favorite factor that AQR uses a lot, and which is momentum, that's just a technical factor that looks at stocks, sort of returns over the past 6 months or 12 months, depending on how you measure it. In this case, we're looking at a 12-month, I guess Pharma French actually use a mix of 6 months, 12 months, definition, where you sort of overweight the sectors, the stocks, right, that have risen more, right, have done better, right, and you underweight or you short the stocks that have actually the losers, right, that have done worse. And this momentum strategy has actually maintained very well. You see the line is basically monotonically increasing with inflation, even though there is a bit of noise, up and down. And this actually is going to be, we're going to put a bookmark on it, because later on we're going to look at trend, and it's going to be reminding us that there is this sort of outperformance coming from some sort of a trend-ish factor. So that's momentum.
Okay.
Now, I want to quickly mention the other two factors, right? Profitability and quality. Interestingly enough, people might think that, if you buy profitable companies and you short, unprofitable companies, this actually is a very sure bet against inflation. But what we are finding is actually it's kind of just mad. It's okay, and then as inflation ratchets up higher, actually, it does poorly. It turns out my suspicion is because highly profitable companies see their margins eroded into, right? So it is not so much about how profitable you are; it's about how much you're able to pass on costs and having the pricing power. Right, so that's profitability, and quality is going to be related, because quality factors tend to often include profitability as being one of the components, the others being like low leverage and so on. So it's going to behave in a sort of a similar way.
Mm-hmm. All right. Okay. And then what's the next slide here? It's the investment and reversal offers some protection with noise. What is your thoughts there?
So here I'm just looking at a few more style factors, and they come from from a French website, except the betting against beta factor, which is coming from the AQR's website. So again, you're looking at factors that are constructed using accounting variables here. The investment factor, you're investing in companies that invest conservatively, and you're shorting companies that invest aggressively, right? With poor investment discipline. You are thinking about like examples recently, like all the tech companies that have really just like blown a hole right in their balance sheets. Facebook.
Okay.
So if you do that strategy, has actually tended to do pretty well as well historically in inflationary regimes. And then there are some technical factors like short-term reversal, which is looking at companies, the stocks that sort of did really well in the last month, and you sort of go short it, and you expect a reversal. So that factor, as well as the long-term reversal, which looks at a longer horizon, some like 10, 5-year, return. So these are factors that have generally done well in an inflationary regime, but they've done well with quite a bit of noise, and because it's such a long history and trading costs and so on, you wouldn't want to place too much, weight on them. But I think informative. Mm-hmm.
Fair enough. Now we get to treasuries.
Yes.
On slide 12, and this is probably what everyone would expect. It's to the down and to the right.
Mm-hmm. Yeah, indeed. So nominal bonds expectedly suffer in inflation regimes because you are sort of committing to these nominal coupons that don't change no matter how much the value of the dollar decreases. So you would expect real return from nominal bonds to be decreasing as inflation increases. So that's the top chart. And I look at two others because recently people have been thinking about what if I hold shorter maturity, treasuries, T-bills, for example, right? Because you would expect that if I just hold 3-month T-bills and roll it over, right, I will be able to, more effectively hedge against inflation because interest rates will increase to help me offset, inflation. But it turns out what happens is that historically that has not really been the case for either the 3-month T-bills or 1-year T-bills because interest rates historically have not risen quickly enough, right, for you to actually benefit from that relationship. And that's most clearly demonstrated recently, right, when the past 18 months we've seen very high inflation, but interest rates only started rising quickly, right, in the last this year really. Right.
That's right.
So
you were behind in terms of in terms of real returns were deeply negative for those ones as well. All right. So which gets us to number 13, which is a new asset class. And so you definitely can't go back to 1940 for this, but why don't you tell us what we're looking at?
So here I am looking at TIPS, right? So TIPS is a very popular instrument for hedging against inflation because after all, it has the word inflation in the name. So everyone wants to hold TIPS to hedge against inflation. And what I'm finding here, what I'm spelling out for people is that TIPS, which were invented in the late 90s, are really just a composite between a nominal bond and an instrument, right? You can think of a derivative or whatever it is that gives you a pure inflation exposure, an inflation expectations, exposure. And if you look at, for example, a nominal bond, and you add to it some sort of an inflation swap, right? That exchanges the stream of cash flows over the next few years, of realized inflation versus a ex ante agreed upon number. Like that instrument combined with a nominal bond gives you back the TIPS index, which is the reason why that if you look at on this deck, right, the left hand side two charts, right, the top one being a nominal bond and bottom one being an inflation swap, you add those two, you can vaguely see that it adds up to the top right chart, which is the TIPS index total return. That's
right. And just let's just make sure people understand that, because I think that's something that's caught a lot of people off guard during this last move, is that they might have gone and said, oh, inflation's coming, I'm going to buy TIPS, thinking that that's going to protect them against the upcoming inflation. But unfortunately, as you mentioned, TIPS isn't just inflation. It's a bond plus inflation. And that bond portion can get hurt. And so if you look at it, you could kind of look at the difference between TIPS and a regular bond. You did a lot better in TIPS this last round, or at least most of it, than you did in a normal bond. But you didn't. It didn't save you by any means.
Correct.
Right.
Yeah, and in fact, once you have done this, mental decomposition, you realize that depending on the type of TIPS you're holding, if you're holding a very low maturity TIPS, right, most of your risk exposure here is going to be coming from the nominal, a bond portion, which has what is called duration risk, or which in other words, they are very sensitive to short-term interest rates, right? So the nominal bond is going to expectedly suffer under inflation, while that overlay of the inflation component is not enough to offset, right, the losses from the nominal bond portion.
So, right. And then it can get even worse if you own, let's say, a 30-year TIP.
Yeah.
It's the expectation of inflation over the next 30 years, And what we found was, although expectations for inflation went up over the short run, it didn't go up at the long end as much as you might have thought.
Yes.
So you kind of you lost on both sides. You lost on the bond, and then you lost in the fact that you were betting on what the market would expect the inflation expectations to be over the next 30 years.
Yes. So that's actually one of the bullet points on the left. I understand we haven't really been following my words on the deck per se, but like one of them, it does say that it's nominal duration exposure is one, and then the inflation expectation may not align with realized inflation because, after all, before the bond matures, right, people can make expectation errors. Let's say inflation turns out to be highly persistent, and when stayed high, we could be right now making an expectation error that we think inflation is going to mean revert, and we all price as though that is actually going to be very low, and then at some point it just adjusts when reality materializes. So that's, I think, part of the reason why long-term tips may not actually help you here if people have wrong expectations about inflation.
And I they'll work over 30 years, but that would be like taking Keynes to the over the long run. We're all dead.
Yeah.
Okay, so what does work? Let's go to this next slide because this gets a lot better and a lot more exciting in terms of protecting you against inflation.
Yes. So of course, the things that do really hedge robustly against inflation are commodities, because after all, they are more or less like entering directly into as input, right, of the consumption basket, either as direct consumption or as input into whatever you do consume. So whether you're looking at things like, these are all futures contracts on underlying commodities, whether you're looking at agriculture, whether you're looking at energy, or whether you're looking at industrial base metals, right, they all tend to have this upward sloping shape, right? Some more robustly than others. You can see a very tight, error band around energy on the bottom right chart, and you see a pretty tight error band around agriculture as well. In base metals, if you recall what we were saying before about industrial, equity sectors, has this slight bend downward towards the higher inflation, because I think as inflation gets really high, the economy slows down such that you actually don't, business don't invest as much, so demand for base metals will go down. But overall, if you combine these into the composite, which is the BCom index, right, Bloomberg commodity index, the different commodity sectors will offset each other such that you get this overall, pretty robust hedge against inflation.
Okay, now Steve, you missed a chart in there, and I'm sure
I was about to come to it.
Oh, okay, you are. All the gold bugs are just waiting and saying, "What about gold?" And some would argue it's not a commodity; it's a currency. But we'll leave that debate for another day.
Yeah. So I want to quickly touch on gold, because I think it also is related to the next slide page we're going to talk about. Is that if you look at how gold has performed over the last a few decades across inflation regimes, it doesn't follow the same upward trending pattern as the other commodities. Interestingly, it has this smile shape. It has this sort of, that performs well, right, in very high inflationary environment. Like we're talking about very, very high inflationary environment. And then on the other hand, it also performs pretty decently well in a deflationary environment, which is typically when you have a massive recession, when you have like 2008 style. And in the middle, right, you see this long range where you basically, it's not far away from the red line, which is zero. In other words, it's not doing very much. And, some people who are surprised by how gold has performed, right, over this past, inflationary episode we've had since 2020, really shouldn't be surprised if you look at data historically that gold has not really been something that would respond very, robustly against inflation when it's just, at a moderately high level, but not super high, hyperinflation.
Okay, now what is the next slide has probably one of the best things out there in terms of protecting against the high inflation, but also offering alternatives at the low inflation.
Yes. So this is actually one of the most interesting things I think in this deck that I was saying is related to what we saw with gold. Is that you have these strategies that are called trend following strategies that are typically sometimes also called managed futures strategies, and typically historically you've had hedge funds that would implement these strategies where you basically buy for any given asset class, you buy the asset that has gone up and you short the asset that's gone down over a certain horizon, whether it's 6 months or 12 months, right? And you essentially are chasing trend, and of course people can implement it in different ways, but generally, if you do it in sort of a generic way, you will find that it demonstrates this smile shape, right? That it protects you against disasters, whether the disaster is high inflation or a deep recession, right? That's the reason why it's sort of tilting up towards both ends. So here I'm showing you the total returns from the Bloomberg GSAM style long short indices, right? And they, I picked them because out of convenience, and also just is a Bloomberg index. And
You gotta support the
yes.
the people paying your bills.
Yes. So if you look at whether it's commodities, whether it's fixed FX equities, you generally see this sort of smile shape. Now I caveated in the deck that because the data that I'm using here, the particular time series is only available as of 2000 to the present day, and we said before that this was a generally disinflationary environment with generally low macro volatility. This smile shape is not very distinct. But if you look at the longer history, I think nearly all asset classes would display such a pattern. I think some other people who have done this study on this particular strategy have shown exactly that. And I summarized the overall, sort of, I think, behavior is that to survive disasters, you need smiles, right? So it is a great addition to your overall portfolio to consider. But again, this is yeah.
Okay, so now let's start to bring all this thing together in terms of portfolio construction. Let's go to the next slide, slide 16. You start talking about defining economic regimes.
Yeah. So the reason I look at this is because we want to think about inflation, but not inflation unconditionally. We want to think about inflation in the context that it arises, right? Inflation. We can have inflation in a growth, environment, such as what we saw in 2021, right? And in fact, right now, people might even say that the economy is actually growing more than people expect, right? We're probably still in some sort of inflationary growth environment. Or you can have stagflation, which is famously what happened in the 70s and 80s, right? But we can also have it again in a stagflationary environment. Growth slows, or even into a recession, but then you still have high inflation. So what I've done here is I've tried to capture this dynamic by defining in some sort of a simplistic way. I guess not overly simplistic, but not in a sort of generic-ish way, how the different regimes. In particular, I look at a 2x2 combination. I look at GDP surprises versus inflation surprises, right? And if we have a negative GDP surprise and negative inflation surprise, then you can categorize that regime, right, as roughly speaking a recessionary, ish regime. Whereas if both are positive, you can categorize that as, loosely speaking, an inflationary growth regime, right?
Right.
And if they're cross terms, then they can be either stagflationary or disinflationary growth. So, and that's exactly what I do. I, basically look at realized GDP, quarterly GDP, and CPI versus 2 quarter ahead expectations coming from the survey of professional forecasts, from the Philly Fed. It's not terribly important the exact way I did do it, but you qualitatively get the same thing. And right now, for example, on the two charts on the right, I show that we are currently in a stagflationary regime, just how I categorize what we're experiencing. But that's
okay.
speaking what we are looking at.
Now, so you do this categorization so that we can see the different performance of different styles, asset classes, stuff, which is on page 17.
Yeah. And I define these regimes so I can get a sense how different asset classes have performed in each of these regimes, how different style factors have performed, and how different equity sectors have performed across these 4 regimes. So, for example, like if we look at the bottom left chart, that shows you how different asset classes have performed across regimes. And you see a pattern that's mostly consistent with intuition, right? So, for example, the blue line, the blue bar, which is the S&P 500 total return index, right? Those have performed best during inflationary growth environment, and even better during disinflationary growth environment, because you get strong cash flows, but you don't see a lot of inflation. And equities tends to perform poorly in recessionary episodes, as well as stagflationary environment, unsurprisingly, because you get squeezed on both cash flow as well as discount rates, right? So that's equities performance. So on the other end, right, you've got commodities which tend to perform well. That's the orange bar, right? The become total return index. It tends to perform well in an inflationary growth environment, which is what we have seen recently, as well as in a stagflationary environment. But the trade-off, right? The catch here is that it really crashes in a recession, right? And it doesn't do very
Yeah,
well.
it's like the biggest
Correct.
negative bar out
And
there.
that is the reason why you don't want to go all in, right, on energy stocks or commodities, in an inflationary environment, because you worry that at some point inflation becomes a stagflation, or sorry, becomes a recession, right? You get a crash, right?
Yeah, and what's interesting is that the U.S. Enhanced Tips Index was so poor there. That's the next worst.
Yeah. So
is that surprising to you?
So that one actually is one of Bloomberg's tips index that we sort of added an additional layer of the pure inflation expectations component, because you recall I was saying before, right? Tips is a combination of a nominal bond plus a pure inflation expectations component. So if people who are not happy with tips, how it has performed, you can layer on top yet another layer through some sort of derivatives, right?
Right.
And that will behave as you would expect, right? You will perform better in the inflationary environment. So the green bar is higher than the tips, right, performance in stagflation or inflationary growth. But the flip side is that it crashes more, right? Because that pure inflation expectation component, right, that you implement using derivatives is going to behave not so differently economically from a commodities, So it's going to inherit that property where you have this trade-off, right?
Now, in terms of, let's go up to the top right here, long, short, style factor. Why don't you walk us through and explain, was there anything that caught your eye that was not what you expected there in terms of their performance during different regimes?
Yeah. So here, actually, we are sort of confirming some of the patterns that we have seen before. Remember, we said that momentum, right, tends to perform pretty well, right, in inflationary regimes. And indeed, that's actually what we see here as well, that the green line, right, momentum strategy on average has performed well, right, in inflationary growth environment and in stagflation, right? And in fact, it has actually performed well, incidentally, in the recessionary regimes, at least the sort of the way I'm defining it on a quarterly frequency. Value, right, has also helped you in a stagflationary environment. Now, I have to sort of caveat here a little bit, because I'm here looking at average. Average, during any given time can realize in a particular number. There's some error band which I'm not plotting here. But what surprised me a little bit was how value here happens to have averaged in a negative way in the inflationary growth environment. So that's what caught my eye. But generally, all the other factors performed, on average as expected.
Oh yeah, that's true. You're the value. Why do you think that was the case? Is that just value's poor performance during the last decade? But that would have been during disinflationary growth, would it have not?
Yeah, that one I'm still sort of investigating, to be honest. I think it may be a little sensitive to the type of designation that you've defined these regimes, and how it has averaged out. Because if you think about the fact that I'm using quarterly data, again, we haven't had really that many quarters, and once you divide it up into 4 categories, the number of observations, right, within each category is not that many for you to actually sort of, so you can by hapstance, get a sign in a particular direction. So in this case, I'm still trying to figure out why, it turned out that way.
Why value? I think you and AQR, because they were struggling with. I think remember Cliff. That's Cliff Asness, right? Is the big boss at AQR.
Yeah, Cliff is.
And he's a little bit of an outspoken fellow at times, and I think he said some things about value over the years that kind of made me laugh. Okay, let's do the last one here:
Yeah.
the U.S. large cap sector returns by economic regimes.
Yes. So this one I am looking at once again, active returns of individual equity sectors, some long the sector, I'm short the market overall. And here you are seeing, a pattern that you might expect, right? So energy sector, right, tends to perform well in inflationary growth and stagflation. That's the top, dark blue energy sector. But what do you expect in the other two regimes? That they crash, right? So they have a big drag in a recessionary regime as well as disinflationary regime. They really lag the market, which is exactly what we have experienced on average, right? And then interestingly, things that will perform well in the inflationary growth environment, things like technology actually performs well. In fact, we saw for a lot of 2020, late 2020 through March of 2021, right? Technology actually did quite well, even as inflation, was rampant. It's only when we started getting really high inflation, the economy, started slowing, then technology started drawing down. And of course, we had the whole as a bubble thing, but so that's technology. And then, there are some other sectors, most sectors with behaviors expectedly like utilities, for example, right, tends to perform well in the stagflationary environment. That's what we expected. And, healthcare and so on. So people can look through the charts, and look more carefully. But overall, I would say, so the different sectors are performing across these 2x2 regimes, generally within expectation.
Right. Okay, which brings us to our kind of towards the end here, the inflation beta Sharpe ratio trade-off.
Mm-hmm.
And I thought this was a fascinating kind of thought experiment or chart that you made up. Why don't you explain to people what we're looking at?
Yeah, so this chart really summarizes everything we've seen so far into one single chart. And what I wanted to show people is that there is actually a trade-off between, buying assets that hedge against inflation and the long-term risk-adjusted return, because there's no free lunch, right? That's one thing we learn in Finance 101. And when you're buying an asset that hedges against inflation, you're buying insurance and you're paying for it in some way. So what I do here is I plot inflation beta, which is basically measured by, essentially inflation sensitivity of an asset's return, right, relative to contemporaneous inflation realizations. So things that are very sensitive to inflation, such as energy, will rank very high on this metric. So they will, be on this chart on the north, west side. You've got BCom energy subsector. You've got BCom index itself, and so on, right? And then you also, and as you travel to the north, the southeast, right? Then you see assets such as the S&P 500 index. They tend to have lower, right? Inflation beta. They tend to be less sensitive to inflation, but they tend to have a higher Sharpe ratio, which is basically a higher risk-adjusted return. And things that are very sensitive to inflation, that have very high inflation beta, such as BCom index, actually has almost like a zero Sharpe ratio because they tend to be so boom and bust over the long run. So what I'm showing you here essentially is that there seems to be a pretty unmistakable trade-off, right? A negative relationship, between these two quantities. And the idea is that you want to formulate your portfolio in such a way that you can get close to what I call a frontier of trade-offs, efficient frontier of trade-offs between inflation beta and Sharpe ratio, such that you get the best bang for the buck, right? So for any given level of inflation sensitivity, you're asking the question, how can I formulate the portfolio that will give me the overall highest, risk-adjusted return, right? Or said differently, you can flip it. You can say that for a given level of risk-adjusted return, right, what is actually the highest inflation beta that I can get?
I get it. Okay. And so from there, you make the efficient frontier. And
so this asset
really, you shouldn't be buying anything that's not on the frontier. Is that correct?
Well, just like if you recall, there is the efficient frontier from the typical risk return space. The assets populate, right, what is lying inside of frontier. Any given asset is going to be dominated by a combination of these assets that offer, mutual sort of that benefiting from their correlation structure, right? So they will bring you closer to the frontier. You see what I'm saying?
Right. Okay.
So
And
so the frontier is really generated by a combination of the assets that are lying strictly within the frontier.
okay. So everyone has to, go back and go back to economists or Econ 101 to learn all that. I've forgotten some of those things to be truthful. And we'll go to your summary, which is the next page 19.
Yeah. So, in summary, I sort of looked at a few, three of these, regimes. At least when I made the slide, I didn't think disinflationary growth seemed that relevant or likely in the short run. So I looked at which assets would tend to perform well in inflationary growth, in stagflation, and in recession. And I list, these assets. So within the asset classes, sort of equities and tips and commodities tend to perform pretty well in inflationary growth. In terms of style factors, you're looking at value, momentum, and trend. And then within energies, within equity sectors, I list the sectors that perform well, and I do similarly for stagflation and recession. The overall message is that you want to sort of mix match, right? These different assets, whether or not you're thinking about in a long only context, or if you're able in a long short context, such that you can balance against potentially the rapid regime shifts that we could be witnessing over the next few years.
All right, going on to slide 20, you actually, Bloomberg has created some indices to take advantage of these strategies, I take it?
Yes, indeed. Yeah, so this, if you recall, this was a presentation given at our portfolio and research index research conference this year, late last month and early this month. So I showcased some of our own sort of inflation oriented indices that that are supposed to, I think, respond well in the inflation regime. So here's just basically an incomplete list of potential ideas from both like multi-asset context, where we sort of mention, one of these, Bloomberg and Index IQ multi-asset inflation index, and also some other ideas that we have had within the equity space and fixed income space. So people can, look at the deck and see if they're sort of find some of these ideas interesting.
And there's more than just this. On slide 21, you have the Bloomberg Pricing Power Index.
Yes. So I here highlight two equity indices that we have built here at Bloomberg. One of them is the Pricing Power Index, where we try to systematically identify companies with strong pricing power by looking at the stability of their pricing margin. Profit margin, that is trading profit margin, and we found that contrary to some conventional wisdom, like instead of looking at companies with very high profit margin, if we look at companies with very stable profit margin, they've actually had done very consistently done pretty well over the long run, and especially during an inflationary regime. So this is just sort of an idea that we try to capture, in terms of pricing power.
And then the next one is the Bloomberg Low Duration Index.
Yeah, so this one was an idea that we had. We are thinking about basically investors are increasingly trying to tilt towards shorter duration assets, right? Duration, basically, you're thinking about an asset whose cash flows are more front-loaded. They tend to be less sensitive to interest rate, change increases and inflation. And in bonds, we already have this concept, right? That long duration bonds tend to be very interest rate sensitive. So we have a similar concept for equities. You can actually estimate an implied equity duration, and you can form a portfolio using this implied duration measure by looking at companies that have had generally lower duration, and form a portfolio with that. And we have shown that actually has turned out to be a pretty attractive risk reward over the long run.
So, Steve, this has been just a kind of terrific quant walkthrough of inflation and how investors might want to set up their portfolios going into an inflationary environment. What was the kind of, to you, when you embarked on this project, which must have been tons of work? What did you expect, and what were the surprises that when you actually went and completed it?
Yeah, I mean, I started looking at this subject, like I said, in early 2021, beginning of 2021, when I think most people didn't think inflation was going to be a persistent story. They said, oh, it's going to be, a few months and it's going to be transitory and it's going to go away. And I always had this sort of nagging feeling as of like March of 2020 that this potentially could be a regime shift. Like if a shock like this does not create a regime shift, then what could, right? So I had a nagging fear that inflation could be a bigger story than expected. And when I was looking into all across the asset classes, I certainly found quite a bit of different sorts things that surprised me a little bit, right? I some of the things like commodities behaved as expected, but then things like gold, things like tips, right? So yeah, I certainly found there's a lot of richness, to how different assets have performed across inflation regimes.
And when you've gone around and talked to people and explained your story, what's been the feedback, and what were they? What are their questions mostly centered around? I'd love to get a little bit of color as you've explained this to people.
I think most people have, I think, the notion that they think inflation regime just means that we have to print 8%, inflation month after month, and that certainly does not sound very plausible, even to the average person who does not think about this subject very long. But indeed, it is the case that inflation regime doesn't really just mean that you're going to print 8%, 9% month after month, or year on year, month after month. Instead, you're going to get very volatile inflation, right?
Okay.
And with volatile inflation is exactly the reason why you want to understand, right, how these different assets perform across inflation regimes, so you can best position yourself for the volatility of regime shifts.
I guess that's a great point, because to some extent we've been stuck in either a recession or disinflationary growth.
Mm-hmm.
And we've had very few forays into, let's say, the really strong inflationary growth or the stagflation. We haven't had that since to some might argue since the 70s or early 80s.
Yeah, I mean, it is indeed the case. Like, investors are operating with the muscle memories of the last 10 years, 20 years. There's ample research, right? People are informed by their own lived experience, right? So we have, I mean, how many people, traders and investors who've actually, experience genuinely high inflation and still remember what it's like? I think not that many. And
no, there's not that many at all.
And most people are operating with the intuition of the last 10 plus years, and they think a recession just necessarily means a deflationary recession, 2008, everything crashes and you get back to basically your Goldilocks of like, QE and low inflation and zero interest rates, and assets, go to the moon. But we actually might find ourselves being surprised by this new economic regime, if one indeed, materializes.
Now, I'm going to put you on the spot a little bit here before we go on to the final three questions where we learn a little bit more about you. But I'd love to go back to the term premium.
Mm-hmm.
One of the surprises has been, to me at least, during this whole inflationary environment, has been, let's just take, for example, the inflation swaps curve. The inflation swaps curve got really elevated at the front, but far-dated inflation swaps didn't rise as much as I would have thought. That would probably been one of my big mistakes. People were quick to think that inflation, although it might spike to 8 or 9 or 10%, it's going to come right back down. The same with the term premium. I've seen different people talk about it, as you mentioned, the fact that it's difficult to measure. But if you had said to me, we're going to have a spike of inflation to 10%, I would have said the term premium has got to expand because people will be more concerned that this could happen again in the future. Yet, in fact, the opposite has happened. I think that the term premium has come in over the last couple of years. Were you surprised about that? And do you have any kind of insights as to why that might have happened?
Yeah, I think we've mentioned, two things here, right? You've mentioned the long-term inflation swaps, and also we've mentioned, term premium. So let me sort of maybe try to address each one of them real quick. Um, I have been, surprised about by the how strongly anchored, right? Inflation swaps have been like just market implied inflation expectations. I've tweeted
Yep.
about this, and if you go on the terminal, you look up the function ECAN, you can see, right, just how strongly anchored, like no matter how much markets keep being surprised by realized inflation as it edges up higher, it quickly reverts back down to around 2.5% or 2%, right, around the Fed's inflation target. It's almost as if there's some sort of mechanical way in which, I don't know if people trade the tips or whatever, using commodity curves or whatever, that has it anchored at 2%. Like, people don't believe it. The bond
Yeah.
market has never really bought into that this thing could be anything but transitory. Now, what I want to say about that, though, is that, caution against that, and this is something that Sargent actually wrote a column about, was that back in the 80s and 90s, right, coming out of that regime shift, when we had a regime shift, into our current disinflationary regime, well, the most recent one, the bond market missed it every step of the way as well, right? We didn't have tips back then, but interest rate forecasts were there, right? And we kept thinking that we were not going to go down more, but we kept going down. And I think one of the biggest beneficiaries of that surprise along the way was probably Bill Gross, right? He was there,
Yeah.
you know.
I made that exact point, Steve, that in 1982, Volcker came and supposedly cracked inflation and broke the back of inflation. But if you think back, there was Dr. Doom, there was Henry Kaufman, and nobody believed that.
Mhm.
And in fact, real rates stayed high against realized inflation for the longest time.
Yeah.
And it took a decade before real rates really came in.
Yeah.
And I've wondered if we're going to have the opposite in this environment, where real rates stay anchored too low because everyone keeps imagining that we're going to have a continuation of the previous decade.
Yeah, it took people a very long time because regime shifts are difficult to believe, right? You always want to believe that things are going to be the same as we had experienced recently. And people didn't believe it back then, I think, for very good reasons, because if inflation was only coming down from demand being destroyed, why should the economic machine be different going forward once demand recovered? And what people didn't anticipate was a streak of very favorable supply shocks like NAFTA, like China entering the WTO, right? Those things that we experienced, right, in the late 90s and 2000s changed the economic machine. And that's also, by the way, why, like, you saw, my hypothesis is that you saw the stock bond correlation plunged from being positively correlated to negatively correlated, right? To bring us back full circle, is that the underlying economic machine and the drivers of the global economic machine changed in a big way. So now, is it possible that we see a reversal of that and see the underlying economic engine change once again? Possible. I think it's certainly something people should be mindful of.
All right, Steve. So we talked about the inflation swaps. What about the term premium? Any thoughts as to why that has stayed stubbornly low?
Yeah. So again, like I said in the beginning, that there are different ways of measuring term premium. So depending on the way, the measure you look at, inflation term premium either has plunged to be very negative, has stayed in negative, or moved sideways, or has actually recovered from being very negative around March 2020 to become less negative and actually modestly positive. So the two measures I'm thinking about are actually the Adrian et al. Measure that is published by the New York Fed, right? That is very popular, a 10-year risk term premium. The other one, if you go on the terminal, you'll find it as well, is the Kim Wright, measure of term premium, where they actually incorporate, macroeconomic variables to measure term premium. So there's all these technical details I don't want to get into. There are issues with which, like, people have, sort of pointed out about, a particular way of measuring term premium, the way Adrian et al. Have done. But generally, my preferred measure, which is the Kim Wright measure, finds that, what the term premium basically bottomed, in during the March 2020 crash, and has actually steadily recovered more recently. In this year, around June, it sort of came down a bit, but it's still higher than the previous low. So I think this more or less reflects the fact that we are seeing a normalization of term premium as we sort of see the economy recovery. And if you believe the story of this idea that supply of government bonds is supposed to be compensated by an increase in term premium, that story sort of is broadly consistent. Now, the local movements of being a bit higher, a bit lower, I think at any given time is just, in my mind, coming down to the fact that it's, the supply of treasury is not the only thing that's moving these economies. There's 1,000 things happening, right? There is the fear of recession and so on and so forth. So when you strip out the different forces, I think that's when you can see some of these patterns a bit more clearly. So going into next year, as we see, for example, how government deficits evolve and how the Fed decides to really move ahead with QT, we might actually see different behaviors on the term premium front.
But if you told me that we were going to have this sort of inflation and the term premium was still zero or just slightly positive, I would have thought you were smoking something, Steve, because I would have said no, the market would get I would expect a response closer to what we saw in the UK. And there they lost control of the bond end, long end, and we have seen no signs that the market has lost control of the long end. And maybe to your point, it has to do with QE, and maybe you're right. Maybe that is ultimately that the Fed's bought a lot of bonds and they're controlling it because to that extent, Japanese don't seem to be having any trouble with their bond market either.
Yeah, between that and also I think what we said, the bond market never really bought into, right? That's right. Inflation could actually be persistent. So the bond market may very well be, in for a rude awakening.
Well, that's what I worry about, and that's what I worry as well about the stock market. And everyone's sitting there saying that they're worried about the stock market crashing, and I've been saying for a while, I think that the bond market is more of a worry, and if we're going to have a stock market weakness, it's going to come from the bond market. Anyways, I'm pontificating too much, Steve. You've been a real pleasure to last this long with us. Let's get to the three final questions that we like to ask all of our guests, and we'll start with one, which is your favorite investment book.
Oh, my favorite investment book is definitely Expected Returns by Antti Imanen, who is a principal at AQR. Have you heard of the book?
Okay. No, I have not, actually. This is great. You've chosen one that nobody's ever chosen. What's the name of it again?
Expected Returns.
Okay.
Yeah, it's by Antti Imanen. I don't know if he's Finnish. I might be butchering his last name, but this is a book that is almost a tour de force of systematic it's of all asset classes, and it tells you through the lens of factors, the sources of returns, why you should expect excess returns or positive returns from each of these asset classes. It walks through different equity styles, some of which we already went through. You walk through, bonds, talks about, carry factor, and so on. And then it talks about, commodities and so on. So it's a great book that I think makes fantastic connection between academic theory, and quant investing in practice.
Well, I'm embarrassed that I don't know it, and I can tell you I've already ordered it on Kindle. It's coming to my house, so I appreciate that. Thank you for enlightening me with that. I should, I guess if I ever have to go apply for a job for AQR, we'll just have to hope they don't listen to this. Steve, so the next question we like to ask is what we call the Byron Wien surprise. Byron Wien defined a surprise as something he thought the market would have believed had a less than 1/3 chance of occurring, but that he believed had a greater than 50-50 chance of it happening. Do you have a Byron Wien surprise for us?
Yeah. So Bob Elliott, who is very active on Twitter, who used to work for Bridgewater, he's been on point on this, which I agree with. I think the resilience of the global economy actually might surprise everyone. Everyone's been forecasting, a pretty severe global recession next year, but I think maybe we get a resurgence of economic growth, in the U.S., China, Southeast Asia, maybe even Europe, and people keep sort of talking about something breaking, but maybe nothing breaks, and you were sort of just in this slog where growth may go bob up and down a bit, and we just have this sort of generally more inflationary environment where inflation doesn't really go away either, but we don't get an outright deep recession that kills inflation.
I'm sympathetic to that, Steve. I wrote recently something about how we've never had more economists expecting a recession over the next year, and I'm just thinking to myself, when have they ever been right? It's they're not. All right, so now the final question: what would you give young people interested in finance or what advice would you give them?
Yeah, so I think students, right, these days, especially grad students, especially non-American grad students, right? I would say, given my own personal experience, I learn on Twitter. Reach out to people while you're, a student. Obviously with moderation, but and take the academic, canon seriously, but not literally, like, because nobody really knows what's going on. Everyone is sort of live figuring out as they go. That's really clear when you go on Twitter and you see, like, Jason Furman, who is the former CEA chair, who's live figuring out and learning new tricks, right? Analyzing the details of inflation baskets, how different sectors have moved, and you see everybody sort of on there, sort of putting out their thought process, and that they haven't really, nobody really has thought this whole thing through. Nobody has a complete theory. Have confidence in yourself and don't second guess yourself too much. So I enjoy the ride.
Well, that's terrific. That's great advice, Steve. It's been a real pleasure having you on. If people wanted to learn more about yourself, and where can they, find you or reach out to you? Why don't you give people kind of some contact information?
So yeah, I'm on Twitter. The handle is Steve Hou F. And that's my sort of Steve, my last name, and my ethnic first name, first letter. That's also on the first page of my deck if people find my deck. And they also can reach me via DM. My DM is open. And then they also can email me at FHO9. FOU9 at Bloomberg.net.
Right. And for those with the terminal, they can also DM you on the terminal, correct?
Mm-hmm.
Which is my preferred way. Poor Steve was trying to get a hold of me. He was worried about it, and he tried a million ways, and then finally he got me on the Bloomberg terminal, which is always the best bet. Steve, it's been a real pleasure. I want to thank you so much for your time. It's been terrific, and hopefully we'll get you again, back here a year from now to find out how inflation is going.
Yes, indeed. Thank you so much for your time.
Thanks. Take care. All right, Patrick, it's time for Talking Charts. What do you have for us?
Well, let's quickly review from a couple of weeks ago what we were watching as the top three things. We were watching those OPEC meetings, the Fed meeting minutes, and those job numbers that came out earlier today. And, well, you know what? We've really seen that while there are certainly market reactions on all news at all fronts, overall the market has really continued to be in the state of like a bear market rally. Every dip keeps getting bought and things keep crawling higher. And while these news events have caused these gyrations, we haven't seen anything that's trend changing. What's your take on it all?
So I would agree that there's not been a change in trend, but I would kind of push back that I think that there's been a change at the Fed, and maybe that was a couple of weeks ago, maybe even a month ago. So we're probably on the same page that way, but it's a little different in that what people are expecting has changed, and it's no longer kind of sell bad news hard, and that it keeps going down. And I think today's a perfect example. We had jobs numbers that were really hot, and the market did open down a long way. But if we had taken this jobs number and done it a month or two ago, we would have opened down 1.5% and closed down 3%. Instead, we opened down 1.5% and closed unched.
Right. All right, so let's talk about the top three things we're going to watch for the next 2 weeks. And even though we talked OPEC last time, I continue to think that crude oil is really interesting. The downtrend has been so dominant. Every rally has failed. Now we did have the infamous turtle head formation happen a few days ago when we approached those previous lows. Had a nice clean dip right below. Looked around, didn't like what it saw, and completely reversed and bounced higher. But again, even today, after a very oversold bounce, a little bit of selling, and overall the pattern of the predominant downtrend hasn't changed yet. I know a lot of people get excited on every uptick on oil, but in my mind, oil needs to clear the mid 80s and get back toward 90 in order to shift this price action and change the trend. And one of the things I'm watching over the next week or two was this rally that we just saw over the last 4 or 5 days, just an oversold bounce. And are we heading right back down to the mid to low 70s again? Or can the bulls finally follow through on something like this and solidify something like a double bottom? And I don't have an answer for it, but I think that's one of the most important things to watch going into next week.
Well, I think there's definitely a lot of oil bulls out there that'll agree with you, Patrick.
Yeah. So number two, we have the FOMC. So that's going to be really interesting. That's obviously several weeks away, but it's going to be really interesting. Obviously, that we're going to get some hikes, but the question is how much, and will they signal whether or not they're going to slow the pace? So, any thoughts?
Well, I think they've already signaled that, Patrick, and that's what the Brookings was. It will be interesting in that we will have 50 basis point hike in December. That's a pretty well done deal. And if you think about it, the Fed used to never hike in December. It's very unusual for the Fed to be hiking in December. And yet here we go, and it could be a dovish 50, which is kind of just a fascinating development.
Yeah. And number one, of course, will be the inflation numbers that will be coming around out about the same time. And it'll be really interesting to see whether or not the trend of inflation backing off continues. Obviously, generally, and we'll talk about with some of these charts, but overall commodities have not been bullish. They have been very sluggish, and that generally alleviates some of the inflationary pressure, especially the ones we saw over the last year. And it'll be really interesting to see whether these inflation numbers follow through on last month and come in on a lower print. Any thoughts on how inflation is going to look?
Well, one of the things I do think is interesting is that we had these employment numbers come in hot, and the market seemed to shrug it off. Will they be able to do the same if we get hot inflation numbers? And although I was probably pretty confident of saying that the market might be able to look through some hot employment numbers, I'm not quite as sure on the inflation numbers. I think the market will be much more sensitive to that. If the trend continues and we get some lower numbers, then everything's great. It affirms what Powell has been saying, and there's no real issue. If we get inflation numbers that end up being hotter than expected, and all of a sudden Powell will be tested in terms of his slower for longer pace, that's where you'll get a lot of tension in the market, and there'll be lots of folks with different opinions, and it will be interesting to see how it plays out from there. It's one of those things that if you gave me the numbers today and they were hotter, I'm not sure what I would do with them after the initial reaction. Obviously it would be very much similar in that if we got a hot inflation number, stock market would sell off, dollar would go bid, and then I wouldn't know what to do. And that'll be the real test.
Yeah. So let's look at the charts on here. I want to start off with that S&P 500, and certainly that little doji candle today is exactly what you were talking about. Obviously, good news being bad news. The market immediately, took the strong jobs numbers as a reason to sell the market, and by the end of the day, we're flat. And the buy on dip came in midday. I think overall, look back to 2 weeks ago when we recorded the last episode. there was the debate where you were relatively somewhat bullish, and I called myself only 50% bullish of you as you. And and really, obviously, over the last couple of weeks, the market generally has been moving higher. And I mean, I think the one thing to watch going into this mid-December period is, will we see the market gain or maintain some of this upside traction, or will we actually see failed rallies? And I'm not actually even going to forecast it, but I think it's incredibly important to watch, because we're starting to get to the levels. I thought this 41 to 4,200 was going to be a level where there's at least a legitimate chance that the market will have a difficult time beating it. And obviously, I know you were talking about numbers a few hundred S&P points higher than that. But one of the things that I want to see is whether or not we start seeing the patterns where, for instance, we have quick rallies and then they give it all back, quick rallies that don't make higher highs, and then we see like overall the price action just struggling to get new money flow to drive higher levels. I feel that generally we remain in a bear market, and bear market rallies, there's a lot of people out there that are convinced it is one. And once we see that the bulls lose any momentum, it might just be just too much, and it might overwhelm the market on a reversal. Anyway, I'm watching that.
Okay, so I'm gonna term something here. So people call it a bear market rally, and then all the bulls are saying, whatever. They're having visions of it running to new highs. I'm going to call it the consolidation rally. And it's neither a bear market rally nor a run of a kind of explosion of a new bull market. This is just a rally within a consolidation that we're going to have for the next, 5, 10 years. You pick it. We're going to have rallies in here. They're going to get everyone excited, and then they're going to fail. But they're probably going to go on longer than the bears want them to, and then in terms of the rallies, they'll probably stop before the bulls want them to. No one's going to be happy. I continue to say that. It's just going to be a lot of chop, but in the meantime, until we get more bulls, I think it keeps going, Patrick. I think it surprises.
Well, you know what though? Okay, so I'm gonna put a little context. Like, I'm not totally against your idea, but I also think that those trends, like inevitably, when we hit a short-term high, and the market turns, could we return back to 3,500 on the S&P, or even dip 200 or 300 S&P points below the October low? Now, if we turned and we, let's say, dropped to, let's say, 3,200, that's still a 20% decline on the downside. It would at least, or at least commonly, would take at least 6 to 8 weeks in terms of settling on the downside. Plenty of bear ammunition to put on short sells for a trend move. Now, of course, that might turn around into an extraordinary bear market rally and rip the market right back up, and your entire thesis will be right. But I actually think a lot of these trends will still be quite tradable in both directions.
I don't disagree, but I guess where I differ is, if it's a bear market, that means that it will be a series of progressively lower lows, which is what you're implying. And that, yes, we'll get sharp rallies, and then next thing you know, we'll be at 3,200. And then we'll get sharp rallies, the next thing you know, we'll be 2,800. And that's where I push back. I think it's going to be, I don't know, pick your numbers. Maybe it's 3,000 to 4,000, and we spend the next decade in this range.
Well, okay. In order for your
or
tell me where
4,000,
but okay, no, but let's talk about this for a second. So under your thesis, the way I would imagine, and tell me where I'm getting it wrong, but I would imagine that there would have to be a certain number of sectors that are rather bullish, and while other sectors are rather bearish, and they're kind of like tearing the index apart as there's things that are going higher, things going lower, and the index can't really make any progress. The question is that what in this basket of the S&P 500 do you think will have a continued bullish price action to kind of put your thesis to work?
I don't know. Maybe it's going to be like I won't say financials because
Thank God, I was about to puke in my mouth.
Scoring from Patrick. I don't know. It'll be a little bit of industrial, a little bit of energy, some financials. I don't know.
Oh my God! See, this is why you're going to be terribly wrong. All right, so let's. I
think though your thought is calling it a bear market rally implies that we are going to have a series of lower lows. And that is all I am pushing back on. I do not believe it is a series of lower lows. I do not think it's a new bull market either. So don't put me in this.
Yeah, okay.
You should just buy it. I just think it's going to be a lot of crap in the middle that's just going to frustrate the hell out of everybody, and everyone's going to think there's going to be 6 months of it going up, and then everyone's going to get bullish, and then it's going to finally turn when the bears seem to give up, and when it seems like it's the most bullish, that's when it'll start to sell off, and then we're going to get 6 months or a year of it kind of grinding lower, and everyone has this idea after kind of lots of events that were very traumatic, meaning like 2008 was traumatic, 2020 was traumatic. We've had a lot of really kind of sharp, quick declines, and I just don't know if it has to be that way. I don't know if it has to be so violent. It could just grind around.
You know what I feel like. I feel like you're trying to make an argument about the way that the price action in some degree or another acted in 2007. If you think back, now, first of all, by then, Fed policy has already shifted. But you had obviously subprime starting to blow up. And even in the summer of 2007, when Bear Stearns, these mortgage-backed security funds started blowing up, you still had in October of 2007 the stock market rally to a higher high, and everyone that was so bearish the market in 2007 got wiped because the market kept bouncing. Every sell-off it had, it kept bouncing to higher highs. But you know what? Like, I still personally think that 2023, next year, has a lot of issues that could come to the surface that could drive very bearish price action. So I don't know if I'm going to be in your camp, buddy.
Yeah. Listen, I'm sympathetic to that argument, and listen, if we get a 2008, I'll be like, I was wrong. But I just think everyone thinks that the next one's going to look exactly like the last one.
No, it never does. And
that's
well,
all
immediately, the reason it won't is because this is not going to be driven from a centric issue of the U.S. financial banking system, right?
Well, that's my point. Is that the leverage in the system is a lot less.
Absolutely.
And there's going to be something else that we don't know about. Whether it's going to be like, who knows, something like there's going to be more leverage in crypto. There's going to be more leverage in private equity. What do I know? I don't know.
It's not going to be a financial crisis. It's not going to be banks blowing up. I'll agree with you on.
And so I think that was. I know everyone wants it to be that way, and I just don't think that's the way that it'll be. And I'll be wrong. And listen, when we're trading 2,000 in S&P, everyone can send me a note saying, Kev,
I don't think we're going to 2,000. I mean, at least it's an outlier.
Listen,
an outlier.
There's a lot of folks out there that believe we're going to 2,500 or 2,000. There's a lot of people, Patrick. If you ask folks, what are the chances the S&P gets halved? there's a lot of folks that are very much in that camp.
I like to always look at things from a probabilities perspective, because I always like to think that anything is possible. I mean, sure, can we see 2000? Sure, it's possible. But would I assign anything remotely to a reasonable probability of it? I would not give it a high probability. Like, I wouldn't be putting money on that kind
Patrick,
of a bet.
Half of the guys you get on that show you cheat with me think that that's probably a good target.
You know what?
That's probably low. Like
no, but like. I have not seen very many people come out saying numbers under 3,000. I've heard a number of guests come on that show.
I think it's just because they don't want to make a prediction of that, because if they're wrong, they look foolish. But I think that if you go out drinking with a lot of people and ask them what they really think, they think the stock market's going to get hacked.
Okay, but like, okay, take something like this NASDAQ chart. Okay, so I pulled up the NASDAQ here, and when you compare this to the S&P, or even better, one of the great calls that a few smart people that I know that I co-host shows with, like you, made the call on the equal weight S&P versus the normal S&P, and that's a great call, by the way, and you can see, like, on this recovery, the thing basically wipes out all of its August, September sell-off in one beautiful fluid motion. And then you look at the NASDAQ, just looks like shit.
Oh, so listen, don't get me wrong, Patrick, because I am the biggest bear on those FANGs.
I was going to say that.
FANGs and all the big cap, and I continue to think that those things bleed. I just don't think it's a crisis.
I think, though, that you're suffering cognitive dissonance, because you're in one. These things are such large mega caps that if they continue to be bearish, there's no way a couple industrials and a couple financials and a couple energy stocks are going to keep the S&P 500 ping ponging into a little trade range. If the FANG stocks go through another massive down leg, there's no way that the S&P stays above the October low.
Oh, I'm not trying to say that it won't. Like, I just don't think it's going to collapse in some sort of event. And that if we get a move down to the October low, and then maybe it goes down another couple hundred, and then it goes back up. And it just doesn't. I just really think it's going to frustrate both bulls and bears. And you just got to figure out who's the position the worst, and you take the other side of them, because I think it's going to continue to frustrate everyone.
So yeah, exactly. Okay, so I like the point that you're making, but I would kind of push back in two ways. Either way, you're going to be right, that it's going to frustrate them one way, but the other way, that it happens so fast no one can profit from it, because it's all materializing too quickly. The one thing that I'll agree with you on is it's not going to be a methodical sell-off where every bearish person is going to have this like Moses parting the ocean moment where they're all going to be able to get short and ride out and make all their profits from from a big downdraft. The market tends to not allow that to happen. It's like a weird, bizarre way that the markets work. And so I either think it's going to do what you're saying, is it's either going to frustrate them by having numerous false starts and just keep watching them out of their shorts till they're bled out, or we're just going to have one period where it's just going to be such a fast initial drop that everyone's going to be like a deer in headlights chasing, and they don't know what to do. Now, I'm not.
I think you could have the other way. I think you could have like a scramble the other way, and I think we might even be in the midst of it. And
like
I ask you,
right?
like, tell me who isn't bearish on the economy next year? Who doesn't think we're going to have a weakness because of the Fed raising rates? Like, shit, this is how prevalent it is. I consider myself somewhat of an optimist, and even I think the economy's screwed next year.
Okay, but my to put the reciprocal of that on, when the market was bullish a few years back and it was going higher, when everyone was sure it was going to keep going higher, didn't stop it from going higher. Like just because everyone's bearish, sentiment is important, but it isn't the sole driver.
No, okay,
Sometimes fundamentals freaking matter, dude.
Yeah.
Like,
I hear you. I hear you. But I would just argue that when everyone was bullish and thought it was going to go higher, it was pretty lopsided on that side. And I don't feel like it's I do feel that it's lopsided on the other side now in terms of everyone's pessimism.
Yeah.
So anyways, listen. I think we've beaten this dead.
Okay. So
it's
listen,
dead. It's not moving, and it's like it's beginning to stink.
Okay, so let's talk some commodities. Gold continues to follow through very nicely. Silver continues to do half decently. Okay. We're going to pass on this. We're going to move on to copper.
Okay.
Okay. All right, let's go.
It's okay. Copper's okay because I don't have a very my position's very minimal, so you're okay.
So, all right, but okay. Precious metals have generally nicely been following through, and the interesting thing is that it continues to be on the backdrop of the U.S. dollar in correction mode. One of the interesting things, just touching back onto gold here, is that will we see a moment where the inverse correlation of gold to the dollar starts to temporarily or even on an intermediate period kind of decouple, and they maybe even just trade on and march to the beat of their own drums? Because really, up till now, almost to the T, when the dollar's down, the gold is up on that day. And so it feels like being long gold here is just a play on the short dollar thesis. But do you think there's the decoupling coming?
The decoupling sounds like some sort of science fiction event.
Well, it's the most.
So I think gold moves. Sorry, go finish your sentence. Sorry.
No, I'm just saying that you call it. It is what it is. It truly has been truly correlated.
So I would say this: that the gold moves on a variety of different factors. One of which is the dollar, and the other one is real rates.
Yeah,
you beat me to it. And you know me; I am the biggest bond bear out there. Okay, and even I am having trouble being bearish around here. Like we're due for a bounce. I think that we're already in it, and for those reasons, I suspect gold goes higher.
Okay.
And I also think there's more complicated reasons. I think it's in a secular bull market because when the U.S. government went and froze the assets of the Russian central bank, I think it put the gold into a secular bull market, because if you're a central bank and you're an actor that at least could be getting in trouble from the U.S. government, you no longer can own treasuries. You have to own something else. And one of the things that you would naturally seem to own that would be a good thing to have would be gold.
Yeah.
So I think it's just, yes, Russia needed to sell gold to pay for things because they got kind of blindsided by the fact that they could no longer use their treasuries and everything else they own. But if you're another central bank, China, you might sit there and go, do I really want to buy more treasuries, or maybe I should buy some gold, because who knows, I could find myself all of a sudden having my reserves confiscated or at least frozen by the U.S. government. I think that's a huge issue that will put a bid to gold for many, many years to come.
Well, you know what? Listen, I'm bullish gold. I'm not gonna deny that, but I don't know if I could ever trade based upon the thesis you just spewed from your mouth. It's a nice story.
Having said that, if the flying doji did something else and stuff like that, I'm all in.
I'm all in under those circumstances.
That's fair enough. Yours probably works better.
The Flying doji. All right, so when we go to the copper chart, again, nice retracement, more or less all of its previous highs from September, October held the pullback, rolled right up. I wouldn't be surprised if we saw 4 to 4.25 here on the upside on this. What's surprising to me though, Kev, is how sluggish uranium has been. This is the Sprott Physical Uranium Trust, and on the spot here, it's just lost its mojo, and it just can't seem to hold any uptick. It's like somebody is, I don't want to say a forced seller because that would be more of a liquidity driven thing, but it just seems this is just not a buy cycle. It's just very weak. And clearly, I mean, I think the thesis in the bigger picture for being bullish uranium is still there, but it's clearly not attracting any money flow right now.
Lost its mojo. Didn't Austin Powers? Did he go forward to find his mojo? When did he go? Or he
had to go back in time to find his mojo. Yeah.
Oh, he had to go back in time to find his mojo. Well, Patrick, you know what? Uranium's got to go back in time to find its mojo. I don't know. It's trading like crap. It's that, and I think
it will turn up at some point, but it's not.
I think it's moving
right
with
now.
energy. It's the same, folks. Listen, if you're long energy, you're probably long uranium. Like those are the crude oil / uranium guys. They're the same ones. They could have like a barrel in one eye and the yellow thing in the other.
Yeah. What's interesting is that the grains have just also struggled.
I haven't even looked at them lately. Oh yeah.
This is the week chart, and it's getting no love. It's really interesting because I mean I do get that decade story of food shortages and all these different things. That it's not like these ideas or these stories don't have merit, but it's certainly not reflecting in these grain prices at all. I mean, this is an active distribution, like people have suddenly decided not to eat during a recession.
I don't know. I think it's listen. I think that was a lot of it was Russia, and as Dennis Cartman used to say, "A weed is a weed, and it can grow." We're always surprised how well it can grow. I don't know. I don't have any opinion on that.
Yeah, but actually, like corn is rolling over.
Yeah, it's not
beans are trading sideways. Just not. And even that weed that grows really big and long, the lumber. Look at this, broke down to a fresh
that's
multi-year low.
Oh, that's bad.
Like, I mean, you have to go all the way back to 2020 to see prices of lumber this low. Lower highs, lower lows. Looks like what the S&P will look like next year, right? It's
actually. Do you have something else that you want to talk about?
No. What do you want?
Because I actually want to do a little public service announcement.
No.
Because I just
on
realized
lumber?
this. No, it's not on lumber. It's actually you reminded me when you pulled up wheat and corn. Now listen. I'm going to say this, and we are not tax accountants. We are not giving tax advice, but I just want everyone to be aware, and I just a big thank you to a fellow that he knows who he is. I've known him and his dad forever. Two of the smartest, shrewdest guys around. He gave me the heads up about a change in the tax law that could affect certain commodity ETFs and also other ones. And in essence, what it is it's something like publicly listed private partnerships in the U.S. If you're a non-American, and just be clear, this is only affecting non-Americans. But my understanding is that if you sell something after 2000 or like after January 1st, 2023, you sell something of one of these stocks, of which WEHET and corn, those two commodity ones, I believe, are one of them, you will be subject to a 10% withholding tax. And one of the things I just like to say, another one that's affected, and this is how I learned about it. I was in Cuppy's Discord, and I saw some fellows talking about it, is BNO. So there's a whole bunch of these different ETFs that will have tax implications. And if you're a non-American, if you're American, just ignore everything I'm saying. You're fine. There's no issues. But if you're a non-American and you own some of these products, you're going to find that that the rules have changed. And I highly suggest that you go and find out the rules and make a decision for yourself. But just be aware that the rules have changed. I believe it's for it's for publicly listed private partnerships. If I got that right.
No.
Anyways, B&O is a big one. A lot of people are talking about. Just a little heads up. Again, we're not giving any tax advice. We're just saying go learn the rules. They're changing as of January 1st.
All right. I want to leave the talking charts with two quick things.
Okay.
First, the 2s10s spread. It's
if
still
anyone's
down.
long that like a steepener, like if anyone just consistently says you got to buy the steepener, that guy's an idiot.
I don't know. Do you know anyone who?
I don't know
that?
anybody like that. That guy is just an idiot, a fool. That thinks
But you can subscribe to his great newsletter
yeah, where he tells you to buy it over and over and over again.
The macrotourist.com. All right. Anyway. But it's just it's like, look, it can't stay this deeply negative forever, but it
might stay longer than we think.
But I was about to say, there is no sign that this is imminently turning. This is still this chart continues to demonstrate all the characteristics of a prevailing downtrend that is intact. Every rally's failing, perpetually lower lows. The point is that at some point, like if you go back and just look, I'm going to put this on something ridiculous like a monthly chart here, right? And like weekly. Let me just see here, a monthly chart. Anyway, but the point is like you have to go back to like never like this. We're talking about this hasn't been this inverted since this chart history going back to 1989 low.
Yeah, I think it's 1982. I believe we were more inverted. So for those that have the steepener on and are looking for some solace.
You can.
I'm going to tell you. I'm going to tell you right here. I'm going to tell you right here. I'm getting. I'm getting to the point where I can no longer. I don't think the trade's going to work anytime soon. So, which means it's going to work tomorrow. You're okay. That's all I can say because I've almost given up on this thing. Like I still have little bits and stuff, and I have Canadian steepeners on, but I understand the argument that we might actually go to record inversion, even though I think it makes
we are at record inversion.
No, but I mean that we go to record inversion and stay there longer than anyone anticipates. And I also
means it's about to reverse tomorrow.
Yes, exactly. That's what I'm saying. That for those that are worried about this trade, don't worry because I'm finally getting to the point where I'm like, oh God, it's never going back.
You're the contrarian indicator.
100%. I'm the Don Cox. Those who know it best love it least.
I'm going to make an inverse Kevin Muir Twitter handle.
You should.
It's I think it's going to work well. Like
you go for it, buddy. I'm not going to be like Kramer and start going, my record is 10 years, blah, 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 blah. I'm going to say, bring it on. Just make sure you have some funny jokes in there because if it's not funny, I won't appreciate it.
No, because your jokes are funny. So the inverse is the jokes not to be
funny.
Well,
some people would argue with you there. They would say, like, I get accused of doing dad jokes, so you could do mom jokes. Okay. Let's go. Let's finish this.
All that I got is I swallowed my beer up. All right. So the last chart, I wanted to just talk about junk and junk bonds.
You keep your junk to yourself. Is what
there you go. And what I was just gonna say is that this, to me, I know like the Nasdaq is really weak and all this, and this chart has been relatively weak compared to that S&P or anything else. But generally, junk bonds move in correlation with equities, even though they're bonds, and they've been very weak. And if you think of what part of the bond market is going to be under the most duress from these really high rates and these historical rate hikes, is these shorter duration bonds that require them to inevitably be refinanced in in the year or two to come, at least parts of the bonds anyway. And it'll be really interesting to see whether we see cracks start to emerge here. When you look at the credit spreads, they really have not been under any stress. I mean, sure, earlier this summer we saw 6% on the credit spread, which is not so insignificant, but we haven't seen the kind of typical blowouts that would, be the 9-10% wide spreads, which typically would be associated with higher default rates and other things that, at least worries about higher default rates that would typically come in. Right now, this area has been quiet.
So
I'm wondering
I'll
whether
push back a little bit. Oh, sorry. I just want to push back a little bit about that because you're pulling up the high yield index as a whole. Go look at the really shitty part, the triple C's plus.
Yeah,
they're a lot worse. It's showing a lot of stress. So I would say
they just dropped from 13% down to 11.
I don't think that's the right quote. That looks to me like it's wrong.
Okay.
Maybe I'm wrong. Maybe there's a new index.
But look at where it was in 2020. It was almost a 20%.
Yeah, but listen, 2020, they thought the world was ending then.
But all I'm just saying, I'm not trying to make a big bold prediction. All I'm trying to say is that I'm watching this space because I think that if 2023 is going to be a shit show, the canary in the coal mine could come from credit spreads starting to widen in this space.
So I will agree with you, Patrick, but I will give a caveat. I think it's the really shitty stuff that just goes lights out. And then the decent stuff, and I don't know how to define that. I'm not exactly sure. But I feel
there's this movie called The Big Short when they started knocking off some of the lower.
Yeah, see, that's where we disagree. You keep thinking that this is going to be a contagion effect and that there's going to be this, all this leverage in the system. And the whole reason The Big Short that occurred was because there's so much leverage in the system. And I just don't think there's the same sort of leverage in the system.
Okay, I don't actually think it needs to be leverage that hits it. All you need is the confidence in the space.
See, that's where I disagree. And I'll push back hard on that. The big crises, they always occur from leverage. That's what causes the real damage.
Okay,
because you get people
allowing many of these companies over the last decade to finance a historically low interest rates, keeping many of these zombie companies alive is a big leverage problem. The fact is that if they're going to have to all pay higher rates, that alone is a massive stress on the system.
And they're going to. Howard Marks has got some crazy amount of drawdown ability to buy shit like this. It just those will go no bid. They will go from 50 cents on the dollar to 20 cents where Howard's bid. That's how it's going to work. And those are going to get crushed, and those are terrible investments. And I don't know if it's triple C's and then the next one and the next one. I don't know where it is, but I think that the pain, this is where I'm saying that I think the real pain is at the shitty stuff that should have never been financed. And the rest of the stuff
that makes sense though.
I think even more so than in most environments.
Yeah,
because I think that this is going to be driven by the economy as opposed to the financial system. But I think that's where it's different.
I think there's going to be a trickle-on effect. I think there's a bigger risk to that than you're giving it.
Okay, that's what makes a market.
Yeah, well, but you know what? One way or another, can you agree that it's like a canary in the coal mine when we start seeing those areas under stress, that could be a bad sign for equities?
No.
Could you agree with that? No. So you actually think that we could have the low-end junk shit blowing up and the market just won't give a shit?
No, I think the market could handle it, yes.
Won't
Like
give a
when
shit.
I think like when whatever.
All right,
bonds-
you know what? I wish we could bet on this one. All right, but anyway.
I don't know. We had to remember we had the same argument that the FANGs couldn't go down without the market crashing, and FANGs went down, and we didn't crash. We grinded lower.
Well, I guess what? Okay, I mean that's all about definition. Like
I guess so.
Most people that looked at their portfolio in 2022 aren't taking
that's because they listened to somebody about their bonds. Okay, let's go on here to the next.
All right, the game. We're gonna.
Okay, now I finally
You
won
got
one.
me.
I've been kind of like out of the loop lately, right?
I caught all the way up, and I got cocky, and we made a dollar bet, and you nailed me. It was
the
an
US dollar-
over under on the dollar and at 107. You clipped me, and so now the score is 22-27. So, why don't you quickly talk about the rules?
Okay, I'll
of the
tell
game,
everyone about the
and
games.
then give me a bet, buddy.
Okay, so pull up TLT while I'm telling everyone this. A Skin in the Game is a weekly opportunity for us to demonstrate that we are degenerate gamblers at heart. Every week, one of us presents a wager, and the other guy chooses which side of the bet he wants. Every wager needs to settle by the next episode, and we're going to play a match to 50 points. We're halfway there. At least I am. The loser of the match will take out 3 lucky or unlucky, depending on how you think about things, Market Huddle listeners for dinner where they can grill them about why he had so many bad calls. So every week, Patrick and Kevin will be able to bet anywhere from 1 to 10 points. We've been mopes. Like, we've had 4s and 5s. We're, like, obviously chicken shit. Anyways.
Well, we don't want to be paying for dinners.
That's right. That's what's going on here. Okay. So we got some TLT, right? We're at 107. Yeah. I actually got a new wrinkle for the game today. Okay, I was thinking about this, and I was thinking about one touches. And I was thinking that it's not really fair that we do one touches and then the payoff profile is the same. Okay. So if Lena is okay with this, I'm going to do a different payoff profile depending if it hits it or not. So meaning I'm going to bet you if you win 5. And if I win, like if it touches it, you get 5. And if it doesn't
but I get the choice of which side.
Yeah, okay. You can go the other way, I guess. That's true. That I win 1. I just know you. You're a buyer of Gamma all the time. So you're going to choose this because I know you're going to like this. So it's TLT. It's 107.79. What is it? 107.09?
107.09.
Okay. So it's 5 to win, 1. Sorry, it's 5 if it touches it, 1 if it doesn't. And here's the number. 1 13.5.
No, this is 2 weeks long out.
2 weeks long out. One.
More importantly, it's through the inflation number and the FOMC.
1 touch, baby. 1 pays 5.
Fuck.
Oh, at least I priced it right.
No, you know what? No, I'm behind. It's stupid for me not to take it, to lose one point. No, I'll take the 5.
All right.
I'll take the touch. No, because like,
yeah,
so what? I'm
going
to be 1 point behind.
I'm going to grind you to death on ones. I'm going to sell vol until
this is a no-brainer. Like if I get the 5, I'm going to tie you.
You hear it, folks? It's a no-brainer.
Well, no, I'm not saying I'm going to win, but it's a no-brainer for me to take that kind of odds.
Okay, so just to repeat, 113.5. If it touches that, Pat wins 5. I win. If it doesn't, I win 1.
That's right.
Okay, now listen. I
that's for this December 16th close.
Yeah, and it has to be during the market hours, Patrick. You can't you can't go ticket there while nobody's looking.
For 5 points, I'm going to do that.
And the real question is, I went and I was trying to figure out how to price out 1 touches on the Bloomberg, and I can't remember. The thing is, I forgot to write it all down. So there is a chance I screwed up on where it should be.
I hope so. So like,
I was like,
you know what? I'll sell you it back for 2 points.
No, oh yeah, no trading ahead of time.
No.
Okay, let's go and do the questions.
Okay. All right. So Lena, come save us, please.
Yes.
So no stupid questions.
It's getting dirty.
All right. Okay.
All right,
Let's do
first
it.
question here. I've argued amongst friends that I need a sarcasm fund. That would have been handy last week when I casually suggested YOLOing my house into physical uranium to quell my jitters about the housing market. That being said, if one of the seats at the table for the Skin in the Game challenge is of the Make-A-Wish variety reserved for a very quote-unquote special huddler, I'm your huckleberry.
Ooh, okay.
I recently watched a clip of Stanley Druckenmiller, Algos Have Taken the Rhythm Out of the Market by Real Vision, talking about how algorithms have canceled price signals in the market. Do either of you two consider algorithms in your trading? If yes, where in your process constructing a trade may you consider them and over what time frame?
Okay. Do you want to go first, Patrick, or me?
You could go first, but I certainly
Okay.
have something to say.
So, first of all, I've seen that video where Stan talks about that, and he calls them algos. I don't know if they're really algos. Like, that's not what I think about with algos. I think about algos as like VWAP orders, meaning or HFT, like more short-term oriented things. To me, this is more quantitative trading is what he's discussing. But keeping in the spirit of what he's talking about, let's address it, where he says the gist of his argument is that the market, it used to be able that you could go and take signals from what the different sectors were doing to make a decision about how the economy or how the underlying fundamentals were working. So I don't know. I guess one of the if he saw utilities getting bid and industrials getting sold, he would imply that, oh, the market thinks that the economy is about to go through recession. And he would, in essence, take signals from the relative movement of amongst sectors within the stock market. And he said that that's no longer working. And I don't know. I guess it's not working. And like all things in the market, if people figure it out, eventually enough people use it that it no longer works, and you have to go to the next level. And
I was gonna go exactly there.
I remember interviewing Mike Masters, and he talked about how when they started their fund, they figured out the earnings and the earnings edge, where they would go and bet on earnings based upon, I can't remember what it was, but they would go and place these bets, and then he realized that everyone else had figured out this phenomena, so he started betting on them betting on it, meaning he anticipated the bettors, and he would actually take it off ahead of the number because so many people were doing it. It made more sense that's where the trade was. And so when I hear Stan talking about that, about how it no longer works, I just think everything eventually doesn't work as well because people figure it out, and then you got to go to the next level.
So like the way I like to look at it, which I completely agree with everything you say, is it's the market is a complex system, and you have to always remember that the market is not made up all of these stocks and commodities and currencies, but it's rather made up of traders and investors making decisions about them. So all these participants are persistently and continuously learning and adapting, and therefore the market is always evolving, and therefore I would imagine that if Jesse Livermore was still around, he would have the same conversation as Stanley did, which is, well, I remember when I was able to trade this way and the market's just changed and it's no longer works that way. Well, I mean, it's just the evolution of the market system, and what makes really good traders good is that they're always learning, always adapting, always recognizing when things have changed, having the ability to assess the situation and see where the new opportunities are. They're always able to adapt to changing conditions.
So are you saying that Stanley Druckenmiller isn't very good and he should suck it up, Buttertart?
No, I'm just saying that. I'm just saying that he's
just giving
bitching
you a
about.
hard time.
I'm just saying he's
Listen.
bitching about the fact that the market is evolving.
Yeah,
and,
and I don't think
evolving.
he's even bitching. I think he's saying this no longer works, and I suspect he's gone on and found new things that work. The guy's a genius.
Yeah, I think so. He's super smart.
Listen,
I'm not going to try to claim I'm better than him.
No, I just I thought it was funny when you said that. Okay, next question.
Okay, next question. Yeah.
Hello, Huddlers. I have a question about the Fed funds rate and how it relates to Treasury yields. If the Fed is increasing the Fed funds rate, which Treasury bill, note, or bond yield is expected to be impacted directly from that? I heard from another guest that the most direct impact is on the 3-month Treasury yield. If so, how? Does the market sell the 3-month T-bills as the Fed announces a hike in Fed funds rate? If so, can't that selling happen across the curve rather than just the 3-month bill or the 2-year note? I basically want to understand how a rise in Fed funds rate affects the Treasury yields. If you can throw some light on it, thanks a ton.
Please take this one, Kev.
Sure. At all times, there is an expected path already built in to the front end of the yield curve. So when you hear people say the market expects a 75 or 62% chance of a 50%, 50 basis point rise and whatever chance of a 75, they're deriving that from the prices of a variety of different instruments. Most of the times it's the Fed funds futures, but it could be other things as well. Meaning that when the Fed goes and actually raises, in terms of the curve moving or any points of the curve moving, it depends on what's already been built in. So you could have a situation where the 3-month Treasury bill actually rises in price because the Fed only raises 25 basis points. And let's just take this next in a couple of weeks, the Fed's going to meet. And right now, 50 basis points is built into those Treasury bills, the 3-month Treasury bill. Let's just use that one to be exact. Okay. So the 3-month Treasury bill is expecting 50 basis points this meeting, and then they figured it out, and they said there's going to be 25 basis points the next meeting, and let's just say for the sake of argument that there's 0 the next meeting. If the Fed went and raised 25 basis points this next meeting, then there would be an immediate repricing of that Treasury bill. But you might say, well, the Fed raised rates. Why is the Treasury bill going up in price, meaning the yield going down? It's because it's already built in 50 basis points of tightening. So when you're talking about how the Fed's movement affects Treasury bills or bonds or whatever it is, it's all versus what's priced in. And it gets a little more complicated as you get longer and longer, but the first few are really easy because it's already kind of there, and they're not going to change it too much versus meaning that there's a high degree of certainty after that next move because there's only another two meetings or whatever it is on a 3-month. But if you take, for example, a 30-year bond, a 30-year bond is in essence a guess on what every Fed funds will be between now and 30 years from now, and plus an uncertainty premium, which we talked about with Steve, which is the term premium. And how that kind of changes is affected by what the Fed does. But the truth of the matter is that the expectation of future Fed policy means more than the actual Fed policy when you're talking about 30 years. When you're talking about the front end with T-bills and stuff like that, it's all versus what's priced in. And I hope I answered it, but that's the important thing to realize. It's only what the Fed does is it's important versus what's priced in, and that's what you have to realize when you're thinking about interest rates and how they move on Fed meeting days.
All right. And Lena, the last one?
Last question here. Hi, guys. I love the show and have been listening since launch, found through my listening of The Show That Shall Never Be Named, also starring Patrick.
You're in another show, Patrick?
I have no idea what he's talking about. All right.
Quick question. We all hear about the Fed raising rates until something breaks. I too can sound very smart by parroting market commentators until something breaks. But I'd rather be smart by knowing what something is and what signpost to watch for indicating something is about to break. For example, is something zombie company collapse led by rising unemployment, maybe untenable increase in unemployment? What numbers? That seems way off. A collapse in the treasury market, unlikely. They'll just change SLR rules. Maybe pension fund issues globally like in UK. Can you please tell me what you think something is? Please also advise what you will look for as a signpost. Thanks in advance for your help.
So, Kev, like the first thing I'm just going to say about this question, the thing is that the thing that always moves the market most, it's what what you don't know, you don't know. And the thing is that the more you can identify a problem, the more likely the market has already anticipated or priced it in. And so this is a challenging thing, like to say that we're smart enough to know where the most unstable part of the market is, where the market is not pricing it in. I guess that's
Patrick. They just have to go to your other show to hear that.
What other show?
Your other show where you're talking about all the other things, the bad things that are going to happen.
There's another show?
There is another show. Yeah.
Okay. No, but like the key here is that odds are that if we're talking about some of the problems that are already out there, that even though those problems can materialize, once a market sees a problem, then often they're able to discount the issues, already know how it's going to affect the markets. If you think of what causes the biggest liquidity events that causes shocks, it's when the market is blindsided by something that no one was anticipating. And so the thing is for us to say, what are those signposts? What are we watching for? Often, I can't remember who it was. There was this one interview in Hedge Fund Wizards, where it's not about having a weather forecast of trying to predict when it's going to rain, but rather actually recognizing when it's just started to rain. It's like rather than worrying about what it's going to be, it's about being eyes wide open that when something starts to happen, you are quick to realize that this is pretty significant and you're one of the earlier ones to respond to it because it just started. Is that what do you?
I would agree to some extent. Like I'd like to say that when everyone's telling me that this is going to be a problem and is the next problem, I generally discount it. Like, let's just take geopolitics. I very much fall into the Marco Popic kind of belief that most of them are untradeable, and that when everyone's leaning one way, it's just an opportunity to fade it. And the very few times I will actually go and trade geopolitics, it's when I think I have discovered something that the market doesn't realize or doesn't care about right now that I think they're going to care about in the future. And sometimes I will even say, I don't even know if this is a real legitimate care. I just anticipate that they might care in the next week or two or next month. But you're spot on correct that if you were actually trying to say, where is the next crisis? I don't know. And not only that, I'm not even sure we're going to have a crisis. And that's kind of what I've been pushing back with. And, I was thinking about you when I heard this question about the fact that you were saying that we should be watching junk bonds for signals. And there are traditional signals that you would look for, and it would be things like the VIX going up or junk credit spreads widening. There are indicators that that kind of introduce that.
But it doesn't have to be a crash when that indicator gives. It's like when I'm saying that that's like a canary in the coal mine, and like what the result of it is not necessarily by default that it has to be like a 30% drop in a devastating liquidity event, right? Like it could be simply just the turn of the next cycle, right?
But I would also push back about, we all hear about the Fed raising rates until something breaks. Yes, we hear about that. And yes, that is consensus. I push back against that really hard. And I say that the Fed this month has shifted. And if you go listen carefully to what he said at Brookings, he's no longer made this kind of, I'm going to crash the economy to get unemployment to 2%. Go listen very carefully. I'll give you... there was a question from Morgan Stanley, I believe, the economist, and he said straight outright to Powell, why aren't you doing a shock and awe to get inflation down? And Powell said, no, I reject the notion.
What do you mean, 75 basis points rate hikes are not shock and awe?
No, Patrick, no. So I completely agree. This fellow was arguing that continued shock and awe was needed. And Powell's comment was, well, I feel like we've already raised rates a long way. And I don't subscribe to the notion that I need to crash the economy and clean it up later to get inflation down today. And to me, that is really what the debate is right now. Because I think too many people were like that fellow from Morgan Stanley at the Brookings the Brookings Institute, where Powell did his Q&A, and believe that that Powell was dead set against being the next Arthur Burns and was going to do absolutely everything to get inflation down to 2%.
Kev, I want to ask you something.
Yep.
All right. So like, what is the lag effect? How do you not know that he hasn't already fucked things up?
Okay,
the fact is
that I agree with you, Patrick. I 100% agree with you, and I think he agrees with you, and he says that. But the thing is, right now, everyone wants him to go even further and break something. And
all I'm just saying is that he doesn't.
He might have already broke things,
and because the thing is, it takes. There's a lag effect. He's raised rates so aggressively at this moment that we don't know whether something is rotting from the inside, whether some sort of cockroaches are in there.
I
6
agree,
months
Patrick,
from now,
and then that's kind of the gist of your argument why the stock market's going to roll over, because the fundamental there's rot inside.
Yeah, well, we'll see.
Yeah,
all right.
But listen, I just think that that's an important point, and I will push back against this idea that the Fed is going to raise till something breaks, and say that the Fed has told you now that they're no longer going to raise until something breaks. They're going to try to feel their way around in the darkness and get to the target in a little bit measured way. And I think that that this is ultimately why I am more bullish than you and a lot of other people, is that I think that a lot of people are set up for the Fed is going to raise something till something breaks. And I'm not even arguing with you that it might have already reached that point, because it might have. And maybe the economy rolls over hard next, spring.
Yeah.
But in the meantime,
this is why you just have to trade eyes wide open. Like I'm not
eyes wide open.
Like you just can't. No, look. Honestly, we don't know. We don't know. Like we can sit here and argue till we're blue in the face, but we don't know. The only thing we can do is every day watch how the things are progressing, and if we see that something is really emergent, then we have to be able to respond.
And
that's
I
what
would
makes us
say,
traders.
For me, I always ask myself, is this something the market knows about and is priced in? And so my suggestion to this fellow would be, when you do start to see cracks, ask yourself, is this something the market is already kind of expecting? Is this something the market knows about? Or is this a surprise? Because it's always the surprises that catch you off guard.
Yeah, there you go.
So I'm with you.
All right. Lena, where can people submit their questions?
They can submit their questions to nostupidquestions@markethuddle.com.
All right. Thank you for tuning into the Market Huddle. We appreciate you spending some time with us. Please follow us at the Market Huddle on Twitter. We're there every day. Lena gets tired of talking to Patrick and myself. You guys know our request. If you could go to iTunes, we'd really appreciate it. Help to spread the word about the Market Huddle. Patrick, where can they find you?
You can find me at bigpicturetrading.com or on Twitter at Patrick Ceresna. And where can they find that amazing newsletter where you're long the steepener?
Well, I like the dig. Speaking of this, actually, I would like to say something. I'm not going to tell you my Twitter handle. Today, I'm going to tell you that I am trying to use my newsletter that I use is Substack, and they've increasingly tried to get a chat feature. It's called Chat. This week, they just announced that it had previously only been available for the iPhone. It's now available for Android. I'm trying my hardest to talk to folks on there. So if you actually want to chat with me, you can go. You don't need to sign up. You don't need to be a subscriber. At least I don't think you do. You can go and you can be a free subscriber and go and check it out and check me out on the chat there. So it's the Macro Tourist on Substack. And the one thing I will say is that I am on there and I see.
So you go to the app and you have to download the Substack app?
Yeah. So there's a Substack app and there's now
a chat feature on it.
There's a chat feature.
Nice.
And listen, I see other folks on there doing it as well, like our good friend Barry Knapp from Ironside Macros. I see him doing a chat on a regular basis. I see that Matthew Klein from the Overshoot just started his. Who else do I have here? Untying the Gordon Knot, good fellow that writes there. He's got.
Now you're making
me
feel left out.
Yeah.
Like, do I have to get on here?
You don't listen. You don't have to. I will say.
Don't worry. Me and Elon are gonna do fine on Twitter.
Anyways, if you're interested, go there. And I'm trying to chat. It's friendly. It's nice. There's everyone's kind. They share things. It's terrific. Anyways, check me out there and listen. Thank you for tuning in. You know, we can never have too many friends. Bear market, bull market. We're just happy to spend some time together on this crazy ride. Now stick around for the after show.
Thank you for the after show because I needed to know how this fluff beer that you're drinking is
so
rated.
It's been a while for me, right? Because you've been doing most of the drinking and I have not been drinking during it.
Yeah, we've noticed your slurring. It's
my
like
slurring,
you're
it's
slurring
already
almost
kicking
as
in.
much as me.
Yeah. First of all, I love the can. So they get huge marks for the logo, and it is an IPA, right? It's just
which is something that causes stress.
What is a DIPA? What does that stand
Double
for,
IPA.
Lena? It's
IPA.
double.
Yeah, that's what gives it that extra percentage.
That's how cool I am. I don't even know what that is. Okay, you know how Patrick says like you have to rate according to the IPA, like you rate how good of an IPA this is.
Yeah. That's I do say that. Yeah.
Okay, I'm gonna do this. I wouldn't rate this high on its own, but as an IPA, this thing's fucking outstanding. I'm giving it.
Wait, you not just outstanding, but it's fucking outstanding.
It really is.
Oh my God!
It's double, and I wouldn't even know it. Like I wouldn't know that that it tastes like that. I am giving this a 9.3.
What?
As an IPA.
What?
It's that good.
Oh my! My mind is blown.
I'm telling you.
You know what?
Outstanding.
You are now going to cause a run to the LCBO for a bunch of Canadians.
I'm going to cause a lot of people to make fun of me.
This is what I was about to say. You better not disappoint because there are going to be people that are going to now be holding you to this. Like they're going to be like, "What is this 9.3 beer?"
Most IPAs are undrinkable. They're like
oh
piss.
my God,
this
they're
is
delicious.
actually good.
Stop it. There are some fantastic IPAs out there.
Anyways, there is one, the Flying Monkeys Cotton Candy Double IPA. Fluffity fluff.
9.3 for the fluffity fluff.
I just like it. Maybe it has something to do that I haven't been drinking in a while, but I don't know. I like it. I'm going 9.3. I'm not going off of it.
Wow.
I'm standing by.
I'm so
it.
curious what it tastes like.
It's like deliciousness. That's what it tastes like.
Deliciousness. I'm in the mood for some deliciousness. Let me get a fluffy fluff.
Oh my God! Listen to this. Listen to the address: 167 Dunlap Street, Barrie, Ontario. Which we understand, Ontario, Canada, and then it gets a little more specific: Earth, Milky Way, the universe, infinity. I like these guys. I think they're smoking.
Yeah, I want what they're
yeah.
smoking.
Yeah.
Yeah.
All right, Lena, you have any good shows to recommend?
No, I've been busy watching World Cup.
Oh yeah. Oh, our poor guys.
Oh yeah.
Okay, I got a funny story to tell you though.
All right.
So, who was it that told me this story now? Oh, I know. I think I can tell you who it was. Is my buddy Matt. He sends me something, and he says that people are referring to us as the cold Aussies.
Oh.
That was so funny. They're like, the cold Aussies don't have that bad of a team. Because they've never seen us on 1986 since we've been in the World Cup,
It's
right?
crazy.
So everyone's confused about us being there, and they don't know what to call us. So they call us the cold Aussies, which I think is hilarious. Like, I think that's a funny line for us, and that's unfortunate that we didn't do better. But anyway, so be it. We finally scored, which I know sounds pathetic, but we have a grand total of 1 goal in World Cup play. No, 2 now. We got 1 the other day, didn't we? We got 2.
You know
Sorry.
what? The team's got to start somewhere, right? Like
Yeah. And this one guy, this Davies guy, he's outstanding. I'm excited about him. Who does he play for, Alina?
Oh, I don't know. I don't know about the
Oh, you're
leagues and
supposed to
stuff.
know
No,
these
I'm
things.
only a really, really big soccer fan every 4 years for a month.
Okay, I'll tell you. While you guys talk that, while I'm gonna figure out what he plays for. 'Cause he plays for a real team.
Well, I think
It's,
they all
it-
do.
it-
They
it-
all have
it's
to.
crazy.
No, they don't all play. Some of them play like recreational soccer and.
Oh, you mean
Like,
Canadian team?
Yeah.
Ah, okay.
But like what a crazy amount. I don't know when I would say upsets, but just like
Oh yeah, Japan. How about them?
Yeah, that was crazy.
yeah,
Germany's out.
like even Brazil just lost.
Well, speaking of Germany, that's who Davies plays for. He plays for Bayern Munich,
Oh.
there you go.
which I think is a real team. Like, I think that's a good team.
Yeah, there were a lot of upsets or surprises
Yeah.
in this World Cup.
Yeah, it's crazy. Like,
Oh, I got something to tell you.
Morocco has jumped like to the top of their group. Like,
Okay.
I mean, I'm not saying that's a shocker, but it's still like just some really interesting outcomes. Anyway, so what you're saying?
I'm sorry, I didn't mean to interrupt, but I
No,
got
go for it.
excited because one of the guys on my desk shot his mouth off, and we were watching Hot Ones. You know, the
Okay.
thing where the celebrity eats the sauces, and he says, "I'd crush that." Well, I'll tell you, I know a good time when I see it. So I immediately ordered all 10 sauces. And we're having a Hot Ones challenge.
When?
We got the pool. Well, I think we're gonna do it the first. Well, there was some problems with the CPI and the FOMC meeting, so we were trying to work it around that because we wanted a soccer game and or a football game. I'm sorry for those that do it properly. A football game while we were doing it, and it ended up being we're gonna do it. I think it's next Tuesday. I'm thinking of
You guys are going to do this like in the middle of the
Yeah.
week? What if you guys can't like make it to the desk?
Well,
the
that's
next
what some
day?
people say.
wait. Are you? Wait. Sorry, but you're also doing.
I'm not
this, or
doing
you-
it. No, I'm not
Oh.
doing it. Some guys, so a couple of the guys have taken me and another guy that is like, there's 2 of the whitest guys on the desk that like basically Wonder Bread and jam and peanut butter, and I am one of them. And I've never had like hot sauce. Like, they were explaining to me something that I don't want to say it out loud, but I didn't even know that happened on the way out. And I was like, really?
Like Ring
I was
of
"Come on."
Fire?
And yeah, and they're like, you've never had that? And I'm like, no. And they're like, seriously? And I was like, I thought they were pulling. I thought they were pulling my leg. I thought they were pulling my leg, and they're like, no, like this happens.
Yeah.
And wait, are they pulling my leg?
No.
No,
It's
they're not.
spicy
The
on the way
Ring
in,
of Fire
spicy
is
on the
very-
way out.
The Ring of Fire is very, very real.
It would have been awesome if they were pulling my leg and I just talked about it. on the podcast. I almost wish they were pulling my leg so I would look like a complete idiot.
I've gone full circle on spice because like I can tolerate a lot of heat.
Yeah.
But I've just started to realize like you don't actually enjoy your food when your face is being ripped off.
Well, when
And,
you're at 2.5 million Scoville units, which is number
Yeah.
10, I don't know if this guy's gonna like it or not. But
His eyes
All I know
might
is-
fall out.
I'm betting him to go on the whole way. He's my boy. He said he was gonna crush it. I believe in him, and we're gonna do it.
You have to
It's gonna
record
be
it.
fun.
Well, okay, so back like 10, 15 years ago when I was playing ice hockey, me and a bunch of the guys on the team went to Buffalo Wings or Duff's Wings or whatever they're called, and they have the hot wings, but they have like suicide.
I think you're talking about Duff's.
Is it Duff's?
Yeah.
I think it's Duff's.
Yeah, Duff's has really hot wings.
But they have suicide, Armageddon, and death wings, or death and then Armageddon. Like they have levels right after suicide.
You get your name
and
up on the board if you finish them.
Exactly, and like like you're saying, I think it's probably in the 2 million plus Stouffville, whatever that rating
Nope.
is.
Duff's famous wings, Armageddon wings, 850.
Okay, Armageddon, 850.
Yeah, that's number 8 on
oh
the
my
on the
gosh,
hot
you guys
Ones
might
challenge.
have to call 911
Oh,
for your
okay,
Here,
so
I
I-
see the
so I-
wall of pain. Did you get on the wall of pain? I see they have the wall of pain.
No, because you have to actually be able to knock a certain amount of them. Like this.
Oh,
was
I
10,
see. The
15
wall
years
of pain is that you've made it, not like
No,
the wall
no,
of shame.
Yeah.
Wait, that was Armageddon was 850. Death above or below
Yeah.
Armageddon?
No, I don't know.
I think Armageddon's
no,
the
I
last
think I
one,
think
I thought.
Armageddon's the top one. Yeah.
I thought. I don't know. We could be wrong.
So 850,000 Stouffville,
Yeah, and
Okay.
this one's 2.5 million.
2.5 million.
Doesn't
So-
matter. I think it's pretty. stupid.
But I'll
Once it
tell
gets a-
you,
yeah.
it was ridiculous. I swear to God, I started zoning out. Like things, like it was like getting high, and like I had like numbness in my pinkies and shit.
Armageddon
like this. Like,
wings?
it was. Oh yeah, it was
I've
ridiculous.
had it before.
When you-
It's not that bad. I just couldn't
Oh,
finish
anyway.
the whole thing.
Lena
Okay.
with the trash talk. I
Look
like
at
it.
the trash talk, like, but that's not the funny part of the story. The funny part of the story is
Next
like
day.
a bunch of idiots. No, like a bunch of idiots. We did it right before going to the hockey game.
Oh no.
And like an idiot, like I'm washing my hands like an idiot. I had to put in contact
Oh
lenses.
no. Oh no. Oh my god.
And I know, so like I'm scrubbing my hands
my
with soap for like 6 minutes, 7 minutes, just trying to get every last little thing. And like now, like okay, I can do this. I can put these contacts
Oh
in.
no.
My eyes exploded. Like I knew it, and I still did it. It's like stabbing yourself in the eyes. It's like the.
Oh my god,
So
the
that
amount
is
of pain. Oh my gosh. My eyes hurt just hearing about it. Oh my god.
It was brutal. All right.
Okay, so we got to let poor Lena go because I
Yeah.
went long and I screwed some things up, and poor Lena's got a lot of editing
Yeah.
to do. I will just say one quick thing for those that are interested. One of my buddies passed along, and thank you. You know who you are. Passed along a great podcast. It's Rachel Maddow, which I know some people are going to be like, "Ooh, that's the left wing." It's called Ultra. It's a podcast series about German infiltration of the U.S. government in the 1940s, early 1940s. Outstanding. It's all history. Don't worry, no politics in there. It's awesome. If you're looking for something to listen to, that's it. And then the other thing is for those with a Spotify, they had recently kind of a fiction or like what is it called? I guess dramatic, kind of. It's almost like the old time radio, a story. And Julianne Moore and Oscar Isaac perform in it. It's called Case 63. I believe it's either a Portuguese or a Spanish thing that was just a huge hit, and they put it in English. It's outstanding, but it's only available on Spotify. There you go. For those who are listening to stuff, go check those two out because they're both out. Like if you're looking for something to listen to, they're both awesome.
All right. Well, have a great weekend, everyone. And thanks for tuning in. And thanks, Kevin, Lena. And have a great one, everyone.
Take care, everybody. Bye-bye.